You are a card-carrying capitalist. You actually have one of those in your wallet.
Yeah.
I've seen it.
Yeah, here it is. I don't know whether that shows.
Those who can't see, I'll show you on this camera right here.
Card-carrying capitalist. And
This is what you carry in your wallet.
All right. Long time no see. Long time no stream. Let me make sure I got everything kind of up and running here. All sorts of settings problems before getting started on the show. How are you all doing today? And first and foremost, I guess, welcome to Minus Investing Live, everybody. It's been, and I don't even know, 5 months or something, probably, since we've streamed. So welcome back to the stream. Thanks to everybody for not abandoning the channel, I guess. Let's start off by saying, if you're watching live or on the replay and you haven't already, it would be really appreciated if you could subscribe to the channel. Also like the stream so you can help get it pumped into the algorithm, maybe get a few more viewers to come join us here today. That'd be really, really great. But either way, welcome everybody. I know I've been gone for a very long time. I didn't really intend to be not streaming for all this period of time. I kind of assumed that I would be able to at least stream a little bit in the interim while I was kind of adjusting to all the changes that have happened in my life. But at the same time, I completely underestimated how big of changes I was going to be going through. Specifically, for anybody who wasn't paying attention and already aware or chatting with me about it, maybe 6 months ago, I did finish my degree this spring, which I had been full-time student for the 2 years prior to that. So that's one of the reasons I had so much time on my hands actually to do videos and streams. But since I finished my degree and got back into the workforce, I have been very, very busy starting a new career. Got a job in commercial banking as an analyst and definitely been enjoying that. It's been a huge learning curve, that's for sure. A lot of things to get to know in terms of the inside of the banking industry. Getting a finance degree is all fine and dandy, but for the most part, they don't actually teach you much of anything about like how to do the job. So I've been basically very, very busy with my company's training program, which for the most part, I'm pretty much at the end of the kind of training part of the job. That's really been like a few months of it. And that's also actually had required me to also leave town multiple times. I had to go to my company's headquarters for part of that training. So I've been in and out of town. I also moved into a new apartment. Also had to get a new computer around the time that my last stream occurred. I was having lots of computer problems. My computer finally gave out, and it took me a while to get a new computer. So basically there was lots of compounding factors as to why I wasn't able to get back to streaming anytime soon. But either way, here we are back again. I'm hoping to stream at least every other week. I don't know that I can say that it's going to be every week, but maybe every other week we'll aim for a stream. And as far as edited valuation videos, no idea exactly how long that's going to take to really kind of come back into form, because I have actually been doing lots of changes to my investment process, and I don't really want to make new videos until I've kind of really solidified exactly how I'm going about that. But we'll definitely be working on some stuff to eventually, hopefully, make some edited videos for. Gulshan, I don't believe I ever remember seeing you live back in the day. Maybe I'm just forgetting you, but either way, welcome to the stream. If it is the first time you've joined us live, you're asking which bank I'm working for. I'm not sure I necessarily want to reveal that on stream. Maybe I will at some point in the future, but I'm a little hesitant to necessarily give out too much of those details. I'm generally a pretty open book about a lot of things going on in my life, but I figured maybe we would leave that detail untalked about, at least for now. Maybe at some point in the future I'll decide that I feel fine about that. But I will say that it is a reasonably large regional bank here in the United States. That's all I will say. Oh no, you're fine. No worries about it. There's it's fine to ask the question. I'm just not necessarily going to answer. But anyway, so here we are looking at my portfolio. There has been lots of changes to my portfolio since the last time we chatted. That's for sure. And I actually, before we actually get into all that, I will say that you probably would have seen or heard about some of the changes to my portfolio if you had been part of the Discord. If you are not part of the Discord, the link is in the description below. Also, the pinned comment in the chat. Come and join, be part of the free Discord. There you can be part of the daily discussions of what we've got going on in our own portfolios, analysis of various companies here. So you can see I posted a thing about the weights in my portfolio only just yesterday. Analysis of companies, thoughts of major investors, publishings of major finance academics, and things like that. So come be part of the Discord. I will say that since the last time we did a live show, I have kind of changed the settings within the Discord. It's still free to join. However, there is a verification process. So if you do join the Discord, you will not be able to see anything initially, and you will essentially have to wait for one of the moderators to let you in. You can you can ping a moderator, or you can message within one of the chat boxes that it allows you to have access to. You can tell what your purpose for wanting to join the Discord is. Basically, we're just trying to weed out people who spam random links to various other sites or bots and things like that. We were running into lots of problems with those types of things. So if you do join the Discord, just be patient. Within 24 hours, you'll be let in, assuming that you have genuine intentions. Goshan worked as a commercial real estate analyst for Newmark. Okay, very nice. I myself will be taking a short stint here, actually in the very near future, into commercial real estate with my bank. I'm part of the training program. As I kind of just mentioned, I was finishing up on kind of the initial parts of the training. But then the next phase of that is that basically over the next year, they're going to be rotating me around to different segments of the operations of the bank to kind of get a feel for different parts of it. And then at the end of that, they kind of make a decision about where they want to place you permanently. And the very first of the segments that I'm actually going to be doing a rotation through is commercial real estate. So actually, I will be getting a little bit of a feel for that myself here only in about a month. So that should be pretty fun. Hopefully, there's some real deals on the table to actually get my hands dirty with. Obviously, commercial real estate has been a little bit of a dry area to be for the last year or so. I definitely have been hearing that from a lot of the other folks within my bank. But obviously, the Federal Reserve is expected to start cutting interest rates here shortly. So theoretically, that should maybe allow for a little bit more deal flow, really just within the overall banking industry, but especially within commercial real estate. But anyway, back to the portfolio. Here you can see the weights and the targets that we have right here. First of all, I have kind of rearranged things. I used to have things just purely put in based off of the weightings, but now I have basically all of the non-individual stock items over here to the left, that being my cash balance, the bar holding, which is a gold ETF, the VU, which is my S&P 500 holdings, which I generally hold through a little bit of a momentum based strategy. So it's not necessarily that I'm holding these over very long term holdings. I kind of buy and sell them depending on different indicators at various points in time. And then I also hold a small cap value index, which is more of a long term holding. I do like to just kind of add to that. It's, as it says, small cap value with a little bit of a qualitative tilt on it, specifically about profitability metrics. And really, I use both of these, the S&P 500 and the small cap value index, to essentially fill in the gaps whenever I don't have enough positions to fill out my portfolio the way I would like to. Because I do try to target a specific cash level, and I don't really like to have really large excess levels of cash. Also, since last time we talked, I have changed my allocation system pretty significantly. I used to have a range allocation system here where I showed a lower bound and upper bound. We have since changed that because of the ways in which I've changed how I calculate it, which we'll get into some of the details about how that works here shortly. But the point is it no longer really makes sense to have a range. Previously, the idea of the range was to have it so that, oh, if I'm initially buying into a company, I want to buy up at least to the lower bound, and then that gives me a lot of leeway in terms of where the capital appreciates to, and also to make just kind of discretionary buys, and then maybe sell once it's over the upper bound. Whereas now, like I said, we've kind of gotten rid of the upper and lower bound concept. It's now just a flat specific percentage target for each item, and we're just gonna try to buy up to that point there. Another thing, for people who've been around the channel for a while, you may notice that some of these targets are actually significantly larger than they previously have been. Like, for example, our largest position, FG, has a target size of 15% when it's already at about 10, almost 11% of our portfolio, which previously I think it was probably still around 10% of our portfolio last time we talked, but I think the target was more like 7 to 8% or something like that. So just to pick on FG specifically, the target has basically doubled since last time we talked. That has to do with, like I said, the changes in the allocation system as is, which also comes together with the other thing that would stand out to people who maybe have seen this portfolio as it was 6 months ago, which is to say we have a lot less individual holdings now. We've definitely cast off a solid handful of individual holdings, one or two of them because the valuations reached their full potential, and so we decided to get rid of them. And also others because we decided to well, abandon the investment altogether due to a change in our perspective around the risks related to those companies. Specifically, we got rid of Advanced Auto Parts. You'll notice that's no longer in here. We also got rid of New Gold. We also got rid of Click Digital. I feel like I'm probably missing at least one other one that we got rid of here, but the point is we got rid of several other options. And a lot of this actually comes back to, well, my new career in some ways, because I have been very, very busy, as I said, learning a lot about how a bank manages risk. And I've taken a lot of the things that I've learned there to heart. So over the last 5 months, while I haven't really done too much new investments in too many new companies, there is an exception there, which we'll talk about here shortly. But what I have done is I've taken very, very close, careful look at all of my existing companies over again, to the best of my ability as though they were new investments, specifically when trying to assess quality. Quality has really been my focus for the last 4 to 5 months. Quality and risk, which I'm going to say that those two essentially go hand in hand with each other. I definitely have, I wouldn't say ignored quality, but definitely minimized the relevance of it in my investing previously. And I decided that, I was definitely probably making some solid mistakes in that regard by not focusing on the qualitative aspects as much. It's not because I didn't think they're important, it's because I didn't necessarily have a strong way to assess them, and I was aware of that. So I just focused on my strengths, that being more quantitative factors, the valuation process. I definitely think that I'm good with the valuation process and understanding what's realistic and what's not realistic on a financial level. I think I'm better at that than probably most people here on YouTube, but I'm not necessarily as good as many of the other people here on YouTube when it comes to assessing management, assessing brands, assessing the story of a company and things like that. I have worked over the last year to 2 years definitely towards working on getting a better grasp on stories and like the themes surrounding investments. But management and brand quality is still definitely something, the strong assessment of which has kind of eluded me. But like I said, been working on that a lot over the last several months. So the point is now I feel like my portfolio is definitely a little bit stronger in qualitative terms. And because of the fact that we've taken this careful look at quality, I've decided that I'm willing to allocate much larger amounts to each individual holding because of that. So that's why the target sizes have moved up as much as they have, is because frankly, previously, I knew that was my weak spot. And so I tried to keep diversified as best as I could to essentially counteract the fact that at any given point, one of my companies could do significantly worse than I was expecting because of some industry specific qualitative factors or things like that. So the point is, I feel much more confident in the quality of the portfolio here. And so I have allocated more strongly to these positions. How I choose the allocation sizes, as I said, we'll definitely get into some of that. That it's based somewhat around a Kelly criterion formula, but it's modified with a lot of qualitative factors. So what I've done is I've actually created essentially a quality star rating system for companies, which I mean, it's mostly just the companies that I have in my portfolio here, although there is the companies that were previously in my portfolio. Oh, Mosaic. That's one of the other ones that I got rid of that I that was eluding my mind there when I was talking about it, as well as Interfor. Those are two other ones that we ditched from the portfolio. But the point is I'm now judging companies' quality on a star rating system from 1 to 5 stars. It's also broken down into 4 different categories, which then weighed up into the overall rating, specifically management, company, industry, and macro. So I'm essentially judging each of these factors: management, which I then break apart into breadth of ability, depth of experience, and interest alignment. I give a 1 to 5 star rating for essentially each of those 3 factors, and then those 3 factors average up into the management rating. And then I have the company rating, which kind of goes hand in hand with brand. I'm kind of like tying brand and company all hand in hand there. And the factors that I essentially assess them on is strengths, weaknesses, opportunities, and threats. Different kind of things that kind of go into each of those buckets. Yo, Aryan, good to see you as well. In mode, what about in mode? Just the fact that I have it, or what? Because I mean, I've had in mode for a long time, so that shouldn't be too surprising to see in mode in the portfolio. Um, oh, the price. Yeah, well, the price is not too pretty. It's definitely, out of all the positions in our portfolio, the thing we are down the most on, down 30% on it. I will say that I do think we are finally starting to turn the corner there a little bit, but we can talk about that a little bit once I finish kind of talking about the weighting stuff. So anyway, the company ratings, as I said, but then there's also the industry ratings, which I kind of assess based off of the growth profile and their investment profile, as well as potential entrants to the industry, the bargaining power of buyers versus the bargaining power of suppliers, as well as threat of substitutes. A lot of these are pretty just like generic concepts from business school, but the point is I'm trying to kind of assess like what are the risks to the company from these kind of 4 different directions. The management, how good is the management? What type of risks does the management bring to the table, or what type of risk do they alleviate because of their skill levels? And then the company and the brand quality, how does the brand stand out versus other brands within the same space? And then the company itself relative to similar companies within the same space. And then the industry, what is good about this industry versus other industries? And then beyond that, we have also macro factors of political / regulatory, economic, social, and technological, which can bring in geographic factors. What country are they operating in? What countries do they sell to? What's the regulatory environment, as it kind of specifically says there? Is there changes in technology that is affecting the company for the better or the worse? And like I said, 1 to 5 stars for essentially all of these different categories. They all average up into their individual little subcategory, and then those also average up into the overall rating. Now, this column right here that we're actually looking at is the average across all of the companies, because I wanted to know kind of like what is the typical rating. So based off of the ratings that I've made for the companies that I've assessed so far, the average rating overall is 2.8 stars, which, 1 to 5 stars, 3 should be approximately the midpoint. So, 2.8, maybe you could argue I'm being a little bit conservative there if it's less than 3% or less than 3. But I will say that a lot of this is open to adjustment. That's kind of the point, is that it allows me to bring non-quantitative factors into my assessment, both, like I said, for the evaluation of what type of weighting I would want to put them in my portfolio, but this is actually going to be used in other ways as well. I've also decided to try to bring these factors into things like the terminal value for my valuations, as well as potential margin of safeties and sell premiums that I might be willing to buy or sell the company at. Well, Ariane, I see you you joined a little bit late, so you kind of missed the initial first few minutes where I talked about why the gap in uploads. But frankly, I have just been very, very busy with a lot of life changes. I finished my degree in the spring, and then was going back to work. I had been out of full-time work for the last 2 years, and so that's actually one of the reasons I had so much time on my hands to do videos and evaluations and live streams all the time. And then I have been very, very busy with my new career. So that's the reason why there's a big gap in the uploads. Um, Hopefully we'll be getting edited videos coming out here again soon. And as I said it at the start, I'm hoping to do live streams maybe every other week going forward. I don't want to commit to every week as of yet, but every other week I think is probably a reasonable level that I can keep to for the time being. So anyway, that's like I said, a basic overview of how the quality system works. I'm still kind of editing little pieces of it here and there, but I have, like I said, already kind of implemented it in terms of how the allocation system works. So you can see that we're much more willing to allocate to various companies based off of their qualitative factors now. Also, the potential upside that we see within the company, that is weighed in there as well. And you may ask, okay, well, why are you so far off? Like on some of these, like for example, Skyworks here says that we can have a target size of 6.6%, but we only have it at 1% right now. Does that mean I'm buying a bunch of Skyworks? Well, no, that doesn't necessarily mean that, because that's not the only thing that goes into account when I'm deciding to make purchases on any given day. The point is that tells me whether or not I'm willing to make purchases based off of how much money I have within the portfolio. But I do want to at least see strong upside to the valuation at any given point. I want to have a nice margin of safety. And like, for example, right now, I only see about 7% upside to my current fair value for Skyworks, which isn't really very exciting compared to lots of the other opportunities. Like, for example, InMode, as we were just talking about, which I see as having 55 to 56% of upside based off of its current valuation. So anyway, getting back to InMode, like I said I'd come back around to that. Um, I don't know how closely anybody's been paying attention to the story with InMode, but a lot of the frustrations that had led to some of the declines in stock had to do with some of the comments from management near the beginning of the year and also at the end of last year around capital allocation. The company has been hoarding cash and short-term securities and has been unwilling to pay that out to shareholders. Hold on a second. Hold on. Sorry about that. I had like a huge hairball. Needed to flip my setting before I coughed. Um, Anyway, so as I was saying, InMode has finally broken down and started doing share buybacks. So that is essentially the major change in the story. That combined with the fact that, as I mentioned earlier, we are finally going to theoretically see some cuts in the federal funds rate here in the near future, and hopefully that will lead to larger amounts of capital spending throughout various industries in the economy. And that's one of the things that's been holding InMode back, is the fact that essentially they're a capital equipment supplier, and capital equipment is the thing that you don't really invest in as part of your investment cycle unless you think that you have strong growth ahead, as well as having decent opportunity costs relative to the cost of the capital equipment. So specifically, that means that like when interest rates are high and consumer demand is expected to be lower because of higher interest rates, you're not necessarily going to invest in higher levels of capital equipment. So if interest rates are coming down, that means the doctor's offices that are supplied with these devices will theoretically be much more willing to make newer purchases of the newer models that the company has been putting out. So hopefully we'll be seeing a return to growth for InMode over the next 12 months. I expect it to be a slow return to growth. I'm not assuming that they're going to return to the massive levels of growth that they had previously necessarily. My valuation doesn't really rely on massive levels of growth in the first place. But the point is that they'll at least start to move that ball forward with actual growth in revenues and then eventually net incomes. And then that combined with the fact that they've been doing their share buybacks, which have been going at a very, very fast clip. In fact, they're bumping right up against the regulatory limits that exist within Israel in terms of how many shares that they can buy back within 1 quarter without having to make a special filings to Israel about that, which they did do after the most recent quarter. They essentially got approval to continue to be able to do buybacks without having to pay a special tax for it. So theoretically, their share count will also be going down while the net income will start to be moving back upward again, which is, the exact combo you want for an explosion in EPS. And then hopefully we can maybe even get a little bit of a re-rating on the multiple as well, because the multiple is also incredibly suppressed on InMode. So, we could get a little bit of a trifecta there where the numerator moves up, the denominator, I'm probably getting my directions wrong here. No, the numerator moves up, the denominator moves up, and then the second level numerator on that being the multiple also moves up. So we could actually get a pretty large explosion in InMode's price theoretically, but I'm not necessarily really expecting that. But point is it's pretty well teed up for basically any form of return to be successful there. When are they going to do buybacks? They have diluted since last 4 quarters. Well, you should look at the most recent quarter. Look at the most recent quarter specifically. If you're looking at a trailing 12 months, then yes, you're not going to see the buybacks because they were diluting 3 quarters ago and 4 quarters ago. But in the last quarter, they were not diluting. In the last quarter, they bought back a significant chunk of their shares. So I would say you have to look carefully quarter by quarter to be able to see the effect of it. But they're buying back shares. I could show it to you. Like, they're making some pretty substantial purchases, but it literally only began last quarter. So if you're looking at a trailing 12-month number, that's not gonna show you really the effect there. So, here, 84.5 down to 83.88. That's as of 6/30/2024. Then they have actually approved for to continue going forward in the future. So it doesn't look like much based off of the number there, but the point is they're moving. It's starting to go. They're starting to buy back shares. The point is you're not going to really notice it on a trailing month level until probably like we're in the 3rd quarter of buybacks. But they're buying back shares. It's gonna begin here very, very well. I mean, it's already begun, but the point is it's gonna show up in trailing 12-month numbers at some point or another. But it only began in the most recent quarter, so it's not super visible. And then not to mention also the fact that they have foreign filings, so they don't necessarily give out the same type of information on a quarterly basis that American companies do. So there's that. Compression of margins. Well, I mean, compression of margins is just going to be a thing because the industry is more competitive. But my evaluation doesn't really rely on them going back to the same exact levels of profitability, so I'm not particularly worried about that. Compression of margins also has to do with the fact that they were on the back end of that capex cycle as I was talking about. So that's a natural part of that cycle. So there actually should be a natural bounce back in the margins to a certain extent, but I'm not even really that reliant on it. For me, it's really just about being able to get back to a sustainable level of moderate growth. And that's the thing is like, even if you really put them in at like 0 growth, they're still undervalued. So I'm, like I said, just, it's probably going to take another 6 to 9 months, I think, for the market to really start to appreciate what's going on in mode. Because that's when it's going to really start to show up in the numbers. But I said turn the corner. When I say they're turning the corner, that's not necessarily to say that like tomorrow they're going to jump up or anything like that. It's to say that in the fundamentals and in the numbers of the company itself, it's going to start to turn the corner. But yeah, I mean, it's been a long wait for InMode, and I've been wrong to a certain extent on how long this lull was going to take. So I can forgive people for being a little impatient with it though. But I'm not. I'm still waiting for it. I also was reasonably pleased when they, I think we did talk about this in one of the last shows, but when they took the CEO out of the chairman position and put one of the other officers in the chairman position. I'm generally not a huge fan of when CEOs are also the chairman. That's, to me, a little bit too much concentration of the power in the CEO's hands. So I also really liked that decision too. That was, in my opinion, a good move that showed that they actually recognized a lot of the concerns that investors had with the governance structure that they had. So anyway, the other thing that might have stood out, as I had already talked about the companies that have left the portfolio over the last several months, but there is one new company in the portfolio, and that is Lululemon. Interesting company for anybody who's not super familiar. Retailer and maker of athletic liege wear clothing, particularly known for their women's leggings, although they have been pushing very hard into menswear as well over the last several years, and that's a huge part of their growth opportunity as well. Very very strong, very strong brand share within those spaces there. The 11th commandment: never invest in apparel. Interesting. What are the first 10 commandments? I don't even. Or are you just talking the biblical list? Because I don't know. I'm not super worried about that. I'm not. I would think of it this way. I'm not invested in the cloth. I'm invested in the brand. That's the thing that I would say is really the key aspect to Lulu, is their brand share, and the mind share that they're taking within different generations. This comes back to, as I was saying before, I've been focusing a little bit more on qualitative factors. So I would argue that Lulu has a pretty good brand relative to most apparel brands. They're not necessarily like, some Louis Vuitton brand or anything like that. Not a luxury brand per se, but a high quality brand nonetheless. People want to be seen in Lululemon specifically. Not just that they're like, oh, I want some yoga pants, and so I'm just going to go get yoga pants. It's also a thing of where they specifically want that brand in particular. People make knockoffs of Lululemon material, Lululemon leggings and other materials, which you could argue is like, oh, that sounds like a big risk. What about the knockoffs there? That means that they're going to be losing out on demand because of those knockoffs. It's like, that's true, but that shows that they're in high demand. It shows that that's the thing that's important, which we'll get to, because I'm bringing up the knockoffs for a reason. We're going to look at some stuff in Lulu here shortly, but the point is they have gotten very very cheap over the last several months, and I decided that they were something worth looking at. Look at this. Went from 500 down to 250 and below. Which you could argue, of course, price declines don't mean anything. If something is was too expensive before, which it was, then that doesn't necessarily make it some bargain now here today, as you just said right there. 18 forward PE. Yeah, 18 forward PE is not super cheap. It's not super expensive either, though. What I would say is it all depends on what you expect out of the company. Now, as I said before, my valuation for InMode doesn't rely on high levels of growth, but Lululemon, the valuation does rely on growth. I wouldn't say necessarily high levels of growth, but the point is my investment in Lululemon definitely relies on the fact that they're going to grow. So there is that. 18 forward PE is cheap if you're expected to grow at an appropriate level anyway. It comes down to what levels of growth we're talking about here. So come over to Lulu's annual report. I kind of wanted to actually share a few excerpts here from just this initial page, the little letter to the shareholders. I thought there was some interesting details in here that really helps, in my opinion, show how the growth is still ongoing. Yes, it's slowed down very significantly. Like if you come over to the financials, you can see like the year over year growth. Let's see, we had like 14, 13, 13, 24, 21, 10, 11, 42, 29, 30, and then back down to 18.6. And then the most recent trailing 12 months, it's back down to like 3 to 4%. So you see going from teens up to 20% in year over year revenue growth, 42% there in 2021. Obviously, that's going to be a little of an exception there, but the point is, even just a simple average of those 10 years worth of revenue growth, and it's like 20%, and then we drop down to 3 to 4% in the most recent trailing 12 months. And so that in itself would explain these types of declines, right? Like that's exactly why those declines occurred. But the point is, well, what kind of growth do you expect going forward? I'm not expecting 20% revenue growth, but I'm also not expecting 3 to 4% revenue growth. And you might say, okay, well, how do you feel so confident about that? I will say I have built a model for them already. So I do actually feel reasonably confident about them. I've kind of thought a little bit carefully about how many stores they could have and what geographies and what type of share they can get and things like that. So I do, I have already modeled out the company. I haven't made a video for them or anything, obviously. But I've done basically the same level of work that I would have done in any of my other videos already for Lululemon. But anyway, back to the letter, because there's just a few little details in this letter that I think helps explain why I feel reasonably confident that the growth is not over for Lululemon. It's slowed down significantly, but it's not over. Okay, so they have this big plan in place that they talk about, their power of three, 2x growth plan, which is a little bit corny, a little bit goofy in the way that they're talking about it. But basically, their plan was to double the revenue from the 2021 levels to 12.5 billion by 2026. They expect to double the revenue over a 5-year period from the 2021 levels. Keeping in mind, as we had just talked about, that the 2021 levels was that really high growth year, right? So they had a huge growth year of 42%, and then at the end of that year, they're like, you know what? We're going to double our revenue in the next 5 years anyway. Keeping in mind that doubling your revenue over a 5-year period is about a 15% CAGR that you need in order to achieve that. So that's essentially what they're arguing. They're saying that, yeah, we know we just did 42% this year, but we think we can do 15% compounded over the next 5 years, give or take. That's essentially what they are arguing. Now, where do they believe that that's going to come from? I talk about here the product innovation. In the trailing year prior to that, they grew their men's business by 15%. The men's business making up a smaller portion of the business overall. Women's business by 17%, that being the larger category of it. And then there are other categories, because they do have other products in a separate segment, of up 36%. Just showing it's like even in that most recent year, they're moving upward very significantly. And those numbers are not out from the 2021 levels. I should point that out. This is the shareholder letter from 2023. So they're talking about the 21 levels in the sentence above that, but don't get confused that when we're looking at these percentage here, this 15% is not from that, it's from 2023. And the same thing for that too. So it just shows that in the most recent annual year, they had very, very strong growth. They've had weak growth in 2024. But I mean, let's look at everything else that's going around the economy, and how many other various retailers, capital companies, and various other segments of the industry. Unless you're in software or unless you're in semiconductors, you've had a relatively weak 2024 for the most part. There's only very specific segments of the economy that have generally had very, very good growth in 2024. So it's not exactly a Lululemon specific thing. It's really just an economy-wide thing. And I do think that the consumer itself is still relatively strong. If you look at a lot of the economic data, the consumers are still buying pretty rapidly. The jobs, the overall employment levels are still very, very strong. I know there was the whole hullabaloo about the revision in the jobs number that occurred somewhat recently. It made a lot of people freak out about the employment numbers, but it is worth noting that those are jobs growths levels off of the back of high employment levels in the first place. So I do think that people were overreacting when it came to a lot of that stuff. And this is coming from somebody that was in the recession camp for a lot of last year, which I was wrong about. So the point is I have rethought a lot of factors about the economy. I do think that, like I said, once we get the interest rates starting to come down, that will definitely start to spur future spending. And I do think that they have their plan in place relatively to continue going forward with that. So other things, their guest experience, they have a really high focus on their e-commerce. Their net revenue, their in-store net revenue jumped 21%, with their e-commerce net revenue jumping 17% again in 2023. And I have the looking here, just to give you a sense of it, in 2023, e-commerce made up about 45% of their overall business. So very, very strong levels of e-commerce, which gives them relatively strong control in terms of keeping the customer on their brand space. And then also that's going to lead to higher levels of capital efficiency, because that means that they don't have to have nearly as many stores to sell as many products. One thing I haven't done yet, but it's something I kind of want to get around to doing, is taking a look at a lot of their closest competitors and showing like the revenues per store, revenues per employees, and things like that relative to other brands. I haven't, like I said, built a spreadsheet out of it, but I have kind of like looked at some of the numbers. And if you just kind of look at some of those numbers, it's pretty straightforward that they themselves are like way more capital efficient as of now compared to those other companies. That doesn't mean that they're necessarily going to be that way in the future, because it's not necessarily that their company is just some super capital efficient machine. It just shows that they've managed to grow significantly beyond what their current footprint normally would get you within the apparel retail space as of currently. They have way less stores, and that gives them a lot more opportunity to expand stores without becoming too oversaturated. Great, welcome to the stream. Evolution AB forward PE is 15 and more quality plus huge moat, but people buying yoga pants over EVO. What about CrowdStrike? From Ariane. Well, I would say there's some questions about Evolution AB too, because if you'll remember, I did go look at that after when you were first sharing that, and you shared some other some investment firms longer thesis about it. I went and read it, and then I built some basic valuation work around Evolution. I do think Evolution is an interesting company, but they are pretty reliant on growth themselves in order to make the valuation work. So I don't know about that, and I'm not sure that I would consider them as having some huge moat either. I think that they're potentially in the process of building a moat, but I don't know how strong of one I would say. And then quality, I don't know. What do we mean by quality exactly? Because I mean, I haven't really looked too closely at qualitative factors for Evolution, but as I was kind of saying at the start of the stream, is like, I don't know. I've done a lot of thinking about what I think quality means, and I'm not sure necessarily that Evolution has it. I don't Doesn't mean they don't, but the point is uh, if you're just looking at the numbers, I'm not sure what quality necessarily they have. Um, so I don't know, maybe, but hey, you've made some banger picks, so you know, stick with your Evolution. I'm not gonna dissuade you. Like I said, I did think it was an interesting company. But it's also, I think, relatively niche, and doesn't necessarily have um, some of the easiest look through aspects to it compared to a business like this. That's the other thing too. It's like you might be able to understand Evolution more carefully than I can, but it's much more arm's length for me. Whereas Lululemon is a very simple business. It has a very simple products. The way it appeals to its customers is very simple, and so it's very easy to understand. Which is true of retail generally. Retail is, you know, one of the easiest businesses in the world to try to understand. You really just have to get a grasp on the product itself. So market expansion. Our business remains strong across global regions, 12% growth in the Americas, 67% growth in China mainland. Again, that's in 2023. Obviously, there has been massive slowdowns in the Chinese economy in this year, but the slowdowns in Chinese economy began last year. So it's worth noting that growth came at the same time as the slowdown in the China economy was already occurring. I'm sure it started to hit them a lot stronger this year, because I don't know what that number is for the China mainland for this year. But the point is that that's pretty good that they've been able to actually still grow even that strongly while China was starting to go into a little bit of its own little slowdown period. I imagine it won't be nearly as strong this year. And I remember, because when I first talked about Lulu in the Discord crit, you mentioned the Chinese revenues as one of the things that you were concerned about with them, but it's only 10% of their business, the Chinese revenue. So it's not exactly some massive portion of their business. 10% is not that big for me. I mean, if it got too much more than that, that would definitely be a worrisome thing. Like if a company has 20-30% of their revenues coming from China, I definitely start to be much more concerned. But 10%, I mean, that's reasonable, I think, a reasonable level of risk to slide off to China. It's like, I have my concerns about China, but they are still a huge market. So it's like it all comes down to whether or not you think the product appeals to the Chinese market. That's one of the other big things that I've always found worrying about China is not necessarily just the economic concerns. Those are a big part of it, but also the cultural differences and the fact that they tend to vie more for their own personal brands and within their own culture. But this one feels and seems, based off of a lot of the things that I've seen online about it, it seems like it's actually doing a really good job of penetrating there. So I feel reasonably okay about that. Now to get to the other question there, Ariana, I mentioned it, but I didn't actually say anything about it. You're asking about CrowdStrike and Airbnb. I don't really have much of an opinion about either of those. Um, I mean, well, I have some like, opinions about them, but I don't really have like any thoughts about the valuation or anything about them. Those aren't really companies I've ever really looked at too much. Airbnb, I think I'm a little concerned about the business model because I don't think that the business model um, is really in its final form yet. Like it's a neat idea, obviously. It's like there's all this untapped potential for people who could theoretically be using their homes for short term rentals and things like that. The idea is sound, but I think that there's potentially some like insurance concerns related to that industry that just haven't really worked themselves out. Like there's a lot of it's I think a lot of people haven't run into the problems yet, but I do think that there is potentially going to be some insurance problems with Airbnb. I don't know. I could be wrong about that, but we'll see. Yeah, quality and margins and ratios. Yeah, so that's kind of what I assumed you meant. But yeah, I didn't want to just say it unless you were going to say it. But yeah, no, that's kind of what I was meaning by that. It's like I'm trying not to really think about quality as just in terms of their ratios anymore. I'm trying to think of quality as non-quantitative at this point. And I I haven't seen anything to make me believe necessarily that Evo is some super high quality company in non-quantitative terms. They might have a high ROIC or they might have high operating margins, something like that, but I think those things are the results of quality. I think those are the things that you get when you are quality. But that doesn't mean you can't have them when you aren't quality too. So that's the thing. That's where I'm saying is like they appear to maybe have quality to them, but that doesn't necessarily mean that they truly are. I would have to look very carefully at their company relative to similar companies, look at their management versus similar managements, and then, like I said, also try to take a look at like customer and other related company relationships with the company and assess their opinions of it as well. Like I said, I've been really trying to rethink how I go about quality within my portfolio, which I'm still working through. It's not some done deal concept. I'm still kind of like working through a lot of the ideas of it. So one other thing I kind of wanted to point out here from the shareholder letter in Lulu before we'll move on was because I mentioned the duplicates. There's a lot of people out there making copies of Lululemon products and selling them. So which is a problem. It's on one hand you can say, oh, that means they're undercutting your opportunity because that means some people are buying those products to Lululemon products. And it's like that's true, but they're copying Lulu. So that means that obviously there's something there that people want that they are unwilling to pay the price for, or they would opt for a cheaper price if they think that they can get the thing for a cheaper price. And then they probably find out that it's not as high of a quality. So anyway, the point is in LA, I think it was at the end of last year, or maybe it was at the beginning of this year, they held a swap event where they actually allowed people to bring in duplicates of Lululemon product and get them swapped out for the real deal, which I thought was a really interesting idea. Obviously, not necessarily that's going to cost them something, obviously. But the point is it might allow for a longer term conversion within the customers. And that clearly is the bet that they're making here. It says here, where about 50% of the guests who traded in product dupes were new to our brand. So they allow 50% of the people that came in with these duplicate products had never bought a Lululemon product and had opted specifically for the duplicate product. And for some reason or another, maybe they were less satisfied enough with it enough to come trade in for the quote unquote real deal. So that's the thing. It's like I do think that they are doing a good job of building a decent brand here. It is apparel, and that means it is fashion, and so that's where things definitely get a little bit tricky. That might be part of the thing that Ariane was kind of pointing to in terms of saying never invest in apparel, because fashion can definitely be fickle. But I do think that they are working more to just be a short-term fashion stint thing, instead actually provide reasonably quality products that people will see as better than the alternative. So hey, maybe I'll be wrong about that one, but the point is I decided to opt for a little bit of a higher multiple company than some of the other ones I often go for in Lulu in this particular time. And it's also worth noting that even within my valuation, I do rely on a little bit of a higher multiple for the terminal value there. For example, like my terminal value is at, I think it's like 19.8 for the effective terminal multiple that I'm applying here. So it's not a super cheap multiple that I'm applying here, but that's weighing in some of those qualitative factors. I do believe that given a return to 5 to 10% revenue growth, which is basically all it really needs, my valuation here is based off of 7% compounded for the next 10 years. Again, we were just looking at 15 to 20% for the last 5 years. So I'm assuming, less than half of that for the next 10 years. That's all they have to achieve. They don't have to go back to 20% revenue growth. They don't have to have magical 40% revenue growth years like they did in 2021. 7% compounded. That's all it needs. And being able to sell at a multiple of 19 to 20 within that 10-year time frame, and also margins that come down to about 20% and less, actually 18.5% on the expected basis, operating margins 10 years from now, coming down from mid 20s to 18.5. That's what I have happening within margins. That gets me to $328, $329 per share. So yeah, I've taken a position on Lulu. It's not a huge position in my portfolio, but you can see that we definitely have some space to add to it. And hey, maybe I'll regret that one, but I don't think I will. We're only just barely up on it, tiny bit right now. It's really just kind of been teetering back and forth between down and up. And frankly, I'd kind of wanted it to go down a bit more because I wanted to add more at lower levels in the short run. But which we were trying to be careful and judicious about that. But at the same time, that's where we're at. Crit Evolution said that they're going to return 100% to shareholders. Nice. That's fine. Doesn't really change any of my thoughts around it. I mean, I assume all cash flows go to the shareholders in my valuations in the long run anyway. So it doesn't really, whether they say that they're going to do that, doesn't really make too big of a difference to me, because I don't it's not some magical thing to me if a company says that they're going to do buybacks tomorrow versus 5 years from now. I know I was talking about that with InMode, but that's only because I was trying to assess people's negative sentiment surrounding the company in the first place. So I mean, that's good for Evolution. It sounds like they're shareholder friendly. But like I say, like I said, I don't think it's a bad company. In fact, like I said, I didn't think the valuation was bad either when I was looking at it before. I did think that it was a pretty decent company. It's just out of my wheelhouse and not something I'm not that interested in focusing on. That was really all I was trying to say. So that's all I'm saying. It's like bringing it up to me over and over again. It's just like, I don't know what to tell you. It's like I've taken my look at it and decided it wasn't really my kind of thing to look at. That's all. It's like I feel much more comfortable with apparel, as perilous as apparel might be. I feel more comfortable with that than a company that's reliant on software and technology that I don't necessarily really understand. And that's the thing when it comes to Evolution. Is like they're building a brand, or their gaming brand, but for that to work, it's going to be reliant on some aspects of technology working well that other people could theoretically do well, and I'm not necessarily sure how to assess those differences. Always doesn't mean I'm unwilling to, because I'm willing to invest in technology companies from here as well. But the point is I have to have some things that kind of back up the fact that I know that there are aspects about the technology I don't understand. So it's just important to understand what you do know
and understand what you don't know at the same time. So anyway, let's see what are we gonna move on to from there. Oh, one other thing I did kind of want to point out. Just a cool thing I noticed yesterday. Um, I finally had one of my companies reach 100% in total returns. A company that hadn't reached that point before. That being FNF, Fidelity National Financial. I am now up 100% in total returns, including dividends and also including spin-offs. Um, Within that, that's how I get to that total 100% there. But it finally reached 100% up as of the close yesterday. When you come over there, it reached like $60 per share. Pretty impressive, pretty crazy. And it's just really cool to think about, because I wanted to kind of talk about this, not because it's some crazy special thing right now. It's not like it's some special deal right now. And also, okay, I mean, 100%, that's fine, right? I mean, you can get other companies with 100%. I've had other companies with 100%, and I've gotten them a lot faster. But that's the thing I wanted to talk about, is really the time frame aspect of it, because I mean, I've had some companies that have doubled in their price, but honestly, I usually get them a lot faster. So the one thing I would point out here is that, people talk about compounders and people talk about being long term and things like that, and then a lot of people with those mindsets flip between their investments 6 months to 12 months out, or the stock races up 100%, and so they sell it. And look, I do the same thing, so I'm not going to pretend like I'm not. This isn't like trying to call anybody there. I myself make projections over a 10-year period. I build my whole model up for the company based off of what I think they're going to do over the next 10 years. And then I buy into the company. And then if it doubles tomorrow, well, I'm probably going to sell, because at that point or another, the opportunity cost of continuing to hold it is no longer as impressive. So I understand, I do those things too. But the point is sometimes, I wanted to show off basically my best example of a compounder that I've experienced so far. I've only been in the investing world for about five and a half years as of this point. And so I really haven't had that great of an opportunity for that many great compounders to exist within my portfolio, necessarily. Well, I mean, or the ones that I did have that opportunity with, I may have sold already, is also the thing too. So Fidelity National Financial, I bought midway through 2019 is when I first got into this company. And you look back, it was like $35 or so, I think, was the first, like around the first price I bought at, something like that, give or take, if I remember correctly. So that's about where I bought it when I had started investing kind of back here at 2018. So it was relatively early on in my career, and it was actually a relatively small portion of my holdings going into the 2020 crash. It was a very, very small position with my portfolio, but you can see it cratered. It absolutely cratered. It dropped by about 60%, 65% or something like that at its peak levels. But the point is throughout 2020, this was definitely one of the ones that I went heavy on. This is one of the ones that coming out of the COVID, I was really betting big on. It quickly became my top position by like mid 2021. I don't know exactly at what point it was, but it quickly became my top position in 2020 and 2021. And then I remember I also took some gains here. I'm pretty sure I started buying back here. I think I took some gains here as well and started buying back more here. And then I've actually, I believe, bought some more up at these upper levels as well. So the point is, I've actually bought and sold more around FNF, probably more than any other specific individual company. Usually when I buy a company and then I choose to sell it, I very often just kind of sell out of that whole position slowly but surely, and then don't have any left over. And then don't necessarily buy back more at a lower level, right? Like I'm not trading ranges on my stocks usually, but Fidelity National Financial has actually been a little bit of an exception to that. One that I've been remarkably successful at, actually. But I kind of wanted to point it out because I often I keep track of my years measure here, but this doesn't track specifically the year from when I first purchased the initial share. This is a weighted number where I take all of the shares I purchased at the prices that I purchased them, and then I weight them together to say, okay, well, at what date did I buy the weighted average of my shares and how long ago was that? So this years column here where it says how many years have I owned the stock, which if you come over here, I also have that on this this little graph right here. You can see which ignore the greens and the reds because that function's all screwed up. So it's supposed to have the greens and the reds on the ones that are over 1 year, but I haven't fixed this for like the last month or so. So it's been all screwy. But point is just look at the height of it. Now, obviously, Fidelity National Financial is my longest held weighted average stock. Now, I actually have held Barrick for longer than Fidelity National Financial in terms of when I first bought into them. Because like I said, this is a weighted number, not based off of when you bought the first share. So this is actually the oldest stock in my portfolio relative to when I first purchased it. But taking into account how much of Fidelity National Financial I've bought, this is the one that is my weighted average oldest stock, and it goes back 3.9 years, taking us back to, well, you guessed it, 2020, mid 2020, which is when I said I was going heavy on it. So the reason why I kind of want to bring that up is because, like I said, it just reached 100% here on Friday for the first time, which is like, okay, cool, 100% over 4 years. That's good and everything, but obviously you could get 100% in 1 year if you pick a company really well. So obviously it's not super impressive in terms of like the return compared to some other things like FG. I got 100% within 1 year. But the point is I think it shows the compounding factor that a lot of people talk about, right? Like I just kind of want to point it out as like a solid example. It's like I take the reason why I use this weighted average year number, the reason why I make that calculation in the first place is so I can know what my compounded rate of return for an individual company is. And so that's how I actually get to this 19.4% that I have right here, is essentially taking the 100% that I'm up and then compounding it back at the 4 years approximately that it is, and I end up at 19.4%. So I've held Fidelity National Financial for 4.5 years, depending on how you want to count the holding period. Like I said, it's actually been 4.5 years since I first purchased it, but it's been about 4 years since the weighted average of my purchases. But that's 4 years of compounding at 19%, which is pretty awesome. So I just wanted to show that a little example out there for people who maybe don't have such rich examples or something like that, or maybe you, like I said, like me, have often sold some of your winners once they've reached kind of a full saturated value, and so you don't necessarily get to see that long-term compounding factor, maybe because you're honestly more successful in the short run than you expected to be, which is, you know, a great problem to have your stocks run up right to your fair value within the first year. Like that's a, you know, it's not like it's a problem to have that issue exactly, that you can't see this longer term factor, but I just kind of want to point it out because I thought that was really cool to think about. And then the other thing to keep in mind when it comes to Fidelity National Financial in particular is that it also gave me one of my other 100% stocks, that being FG themselves. Because as I said before, this 100% includes the dividends as well as the spinoff. So FG was a spinoff of Fidelity National Financial, and essentially the way I chose to account for that is that the drop in price that came from Fidelity National Financial when they made that spinoff to the shareholders, at the end of the day, on that first day there, I essentially took that change in capital and I turned it into my cost basis for FG. So essentially that became a negative cash flow for the cost basis of FG, and then that became essentially a dividend for FNF. We essentially transferred some of that value over to the cost basis of FG, and that's how I chose to account for it within this system right here. So that's how we actually end up with that 100% there. But the point is then we 100%ed on top of that dividend, so to speak, which is pretty awesome itself. Ariane, total return negative 41%. Yeah, ignore this right here. There's some issues with my spreadsheet right here. For like how it calculates my total returns. That's actually part of the reason I haven't scrolled down here. For anybody who may recognize that from 5-6 months ago, there's like return stuff charts that are below this. That's because all of my calculations are like all screwy right now in the spreadsheets in terms of actually calculating my portfolio total return. But no, yeah, ignore that. That's 100% not accurate. Yeah, my portfolio is not down 41%. It is still up. I don't know what it was at, like 50 or 60% or something like that. I don't know what the number was at, but it's not that far off necessarily from where it was like 4 to 5 months ago. Because honestly, my portfolio has kind of treaded water a lot over the last several months. Admittedly, it's kept track approximately with the small caps, but it's still underperforming the S&P 500 on the year pretty significantly. But yeah, like just ignore these. These two are not accurate, which also means that this one's not accurate, which also means this one's not accurate. So yeah, there's parts of this that are screwed up. I'm hoping to maybe fix some of those things here in the near term. But the point is, I was like, whatever, we can't fix everything before we go live. Let's try to just get back live and share what we can. You know, that was kind of my feeling about that. But yeah, no, we're not down 41%. Definitely not. Do how to build a dashboard like mine? Well, I don't know what your dashboard's like, but I like my system for doing it. It just if you don't update certain parts of it at the end of the month, then it starts to screw things up. And then, like I said, I've been just very, very busy with my job, so frankly, I just haven't had a lot of time to worry about this. Not to mention, I've been out of town, and when I'm out of town, I don't have access to my computer in the same way. I can access a lot of this stuff because this stuff is on Google Sheets, but then from like my work computer, but then I'm actually limited in what I'm allowed to do with my work computer. Like I can look at stuff on Google Sheets from my work computer, but I can't actually like work within those sheets because of the security restrictions for my company. So the point is like I've just been limited in what I've been able to update on my spreadsheets while I've been out of town and busy. So that's basically the reason why it's like that. But I know what the problem is. I just haven't gotten around to fixing it because I've been focusing on other things like all of the qualitative research that I've been talking about. So anyway, let's move on from that. There we did have some other stuff to talk about. Where do we want to go next with it? Let's talk actually about some of the other research I've been doing because I just kind of mentioned it. I might as well get into some of that. So one of the things that I've been especially focusing on over the last few months with the qualitative research when trying to assess the company, the management quality, I have been looking very, very closely at compensation packages and building kind of this spreadsheet here for how I'm judging compensation packages and going real deep on the proxy statements that kind of spelled all of them out. So here I have all my companies with all of their managements and their boards listed out, all of the individuals, as well as there's like a few other ones that aren't in my portfolio that are still on this list here just because I still have them there. And then I have this like main spreadsheet where I've taken a lot of the numbers together. Down here, we actually have like a lot of the pieces. We take a look at like the salaries for the CEO and the chairman and the executive and the board. And then we also take a look at the bonuses. And then we also take a look at like the total cash payments being the salary plus the bonuses and try to take a look at like what amounts are incentive pay versus non-incentive pay. And then we also take a look at the equity portions of their compensations. And then we also take a look at their actual ownership levels. And then we're also trying to take a look at the total amount of the executive management team as well as the board as a total, but then that amount minus the CEO as well as that amount minus the chairman. So we're trying to take a look as like, okay, how much skin in the game does the CEO have? How much does the chairman have? How much does the kind of like lower level executive management have? And then all trying to normalize a lot of these numbers in ratio form against a lot of other factors here. So like here, let's take a look at some stuff here. We like, for example, we have like the stock comp, and stock comp, just like the total stock comp coming off of the cash flow statements. And then that we take a look at it as a percentage of market cap, as a percentage of sales. You can think of it as a percentage of sales because that's making it more like an operating cost, and then percentage of market cap because that makes it more like a dilution factor. Jonathan, hey, what's up? Hopping in to say hi. So here we also take into account whether the CEO is on the board. As I kind of mentioned before, I'm not a huge fan of when a CEO is the chairman because I do think that can be a little bit questionable in terms of like the governance structure. There are exceptions to that. Like for example, if you have a founder CEO and they happen to also be the chairman, well, then I'm willing to kind of think of them as that maybe being a good exception there because we like founder CEOs. And so they happen to be the chairman, and that can make a strong thing there. But as Jonathan just mentioned there, if the CEO is also the chairman, then it creates a huge conflict of interest, especially when it comes to constructing these compensation packages in particular. So definitely something to be worried about. So we have these little check boxes for each of the companies to kind of like pay attention to those factors. But then we get into the actual quantitative factors. We have total cash pay as a percentage of sales, total equity pay, the equity pay as a percentage of market cap and as a percentage of sales. And then we have an interesting ratio that I liked that I wanted to take a look at. Ariane, see you later. I'll catch you in a few weeks. So here I took a ratio of the equity pay to the insiders as a percentage of the stock-based compensation. Now I say as a percentage, but I'm actually putting it in ratio form here, mostly because I just didn't want to have too many percentages here. But this was an interesting ratio, which isn't perfect and doesn't really make 100% sense for every company. But the idea is for like this one here, we're looking at Fidelity National Financial, and it's 0.29. So it's saying that about 29% of all of the stock-based compensation goes to the insider. And what that means is that 71% of it doesn't go to the insiders. So who does it go to? Well, that means it goes to the other employees. And that's something that I actually wanted to take a look at. I was like, okay, well, how much stock-based comp are the non-insiders getting? Because obviously, people don't like to have huge amounts of stock-based compensation, but I tend to be much more okay with stock-based compensation, I think, than a lot of other investors. At least from my perspective, that's the way it feels. Is that, like, for me, it all comes down to what am I getting for the stock-based compensation. I'm fine with the company paying out stock-based compensation. I'm fine with them paying out even significant amounts of it, as long as what I'm getting for that is something worthwhile. And what you want is strong operating margins, strong returns on capital, and strong skin in the game. So if you're getting those things for it, then that's a competitive advantage, in my opinion, to be able to hand out strong amounts of stock-based compensation. So that's why I wanted to look at this ratio, because if you know that 71% of all the stock-based compensation is going to non-insiders, then that means all those people in that company that are getting that, they're heavily incentivized to do well, right? They're heavily incentivized to think efficiently about the company and to try to operate the company well. For Fidelity National Financial, that's going to be agents, that's going to be consultants, that's going to be administrative staff. They handle mortgage insurance projects and escrow services, right? So that's what they do, is they do mortgage refinance and escrow services. So that's the type of things that they do. It's a lot of agents that are going to be picking up that type of stock-based compensation. For a tech company, it might be in the R&D staff, right? Like look, coming over here, I have Apple right here. Apple, only 1% of the stock-based compensation goes to the insiders. 1%. That means 99% of it goes to non-insiders. 99% of it. Who is that going to? The R&D staff. Also the administrative staff, largely. So that's pretty fantastic for Apple. Now, Apple's not great in some other factors here, as you can maybe notice by the red that's pointed out right here. So there's lots of factors to take into account, which is why we have so many different measures here that we're kind of trying to take into account. There's not just one thing we want to look at. But the point is, this was one ratio that I've never seen anybody else ever really particularly talk about: the non-insider portion of stock-based compensation. I wanted to actually get like a measure of that. Now, I do also have median measures here on the left-hand side across all of the companies that I've measured, which is only like 15 to 20 companies or something. So it's not like a huge sample size or anything like that, but I'm hoping to expand it over time and try to build like a decent kind of like statistical data set here of like what's typical for a lot of these companies. So like for stock comp as a percentage of market cap, out of the sample I have here, 0.5 percentage point of dilution per year is what is maybe typical. That's, kind of a lot, but not necessarily a lot. But I would also point out that the 15-20 I have here is probably going to be sample bias. Like, I'm probably opting towards companies that have high insider ownership based off of the companies I picked. So I'm hoping to kind of add some more kind of somewhat random companies to the mix over time to kind of try to buff out those statistics a little bit. But then as a percentage of sales, it's like 1%. So maybe a 1% drag to your operating margin based off of your stock-based compensation. What's the count of executives versus the director count? So 6 executives, named executives, 6 named executives that they have in their proxy statement. They probably have more technically executives, but again, I'm talking about the named executives that they give the compensation information for in their proxy statement. And then the same thing for the directors, 8.5 is the average, although for directors, it's actually the total amount, because in a proxy statement, they have to tell you about all the directors. They just don't necessarily have to give you the compensation for, every single middle manager all in the organization, but they do have to tell you at least all of the directors, because it's a little bit more of a limited pool. And then I also take like a median case about whether or not the CEO is on the board. So typically a CEO is on the board. That is actually the most common scenario, is that they are on the board. It's not necessarily that common that they're the CEO, though. That is less typical, and it's obviously definitely not super common that a founder is the CEO/chairman either. So like these are just the median measures for across the sample set that we have here. Then, like I said, equity ownership, 1% is equity ownership is the median case across my sample size, which should just go to show that this is a little bit of a biased sample, as I was kind of already pointing out. It's like the fact that there is a 1% insider equity ownership within the sample size is, as a median, is definitely more than average, right? Like the median company does not have 1% insider equity ownership. So definitely a biased sample, but nonetheless, like I said, we're working to maybe build out the sample set over time. Jonathan, coming through 10Ks is so helpful, but many people are lazy or don't care. Yeah, I mean, I like to think of myself as like a 10K pro to a certain extent. I'm really good with 10Ks, but I had definitely never given that much attention to proxy statements. And that's where most of this information comes from, is not from the 10K. This stuff mostly comes from the proxy statements. They sometimes include some of this stuff in the 10K, but they usually don't include all of this stuff in 10Ks. Sometimes they'll have like a really robust compensation section in 10K, but oftentimes the compensation section in the 10K is a little simple. It's a little kind of just like cut and dry, very simple details. But if you go to the proxy statement, that's where you really get like every detail imaginable that you could want about their compensation package. Like how many things that they get from every specific thing. Oh, you're saying, well, SEC filings generally? Well, yeah, of course, definitely SEC filings generally. And like I said, it's like I myself would, I would say it's like I have been lazy in the past when it comes to proxy statements in particular. So that was one thing, like I said, over the last several months, I've started to say, okay, you know what? We need to become as good with proxy statements as we are with 10Ks. We really need to understand this. It's like we need to be looking at these every single year. We need to be taking a look, seeing what's changing, what's different. And then there's other things to take into account with these things too, because like I'm talking about the numbers here, but when we down here, I have some of the details written in here. But like when it comes to the equity pay that they give out, there's often large chunks of it that come as a result of vesting, which is just a time-based measure. It's basically to make it so that the insider, the executive wants to stick around the company long enough to get those shares, right? They like oftentimes it's like a 3-year vesting schedule. So like they'll be granted it in 1 year, but they're only going to get 1/3 of it as of the end of this year. And then they'll get 1/3 of it from next year, and then 1/3 of it the next year after that. And then somewhere along the way, they'll probably get a new package granted to them. So that it kind of keeps this like overlapping vesting schedule that makes it so that the CEO always wants to stick around at least another couple years, at least, right? Ideally, you would want a longer than 3-year schedule. 3 years is definitely the typical length of a vesting schedule that I have found. I have found some 4 or 5s in there as well, but man, it would be great if you could find some 10-year vesting schedules. People let me know. People let me know if they find companies that have 10-year vesting schedules to their equity grants. I would love to know what companies are out there with that. Also another thing, I don't know if Crit's still around, but he was talking about it in the Discord at one point. There's the rare companies that are out there that don't give equity grants at all and instead require their executives to buy on the open market. He was bringing up Constellation Software, which is like one really well-known example of a company that does that. If people know of other companies that do that type of compensation plan, please, by all means, comment them below. I would love to take a look at them. Other than, like I said, Constellation, which is one that's kind of already well known and is not particularly cheap. So that's another complicating factor there. But the point is as I was just saying, when it comes to the equity grants, there is vesting schedules, but there's often other metrics for like half of the amounts that they're granted to. Like maybe they have to hit certain operating margin targets. Maybe they have to hit certain working capital targets. Maybe they have to keep certain levels of cash on hand. Maybe they have to get their leverage levels to certain levels. Maybe they have to hit certain sales targets. Maybe they have ESG targets. I've seen some of those in here as well. Or production targets for mining companies as well, things like that. So I've tried to take note of all those factors too. It's like, which is something you can't necessarily super quantify when you're trying to compare one company to the other. Like obviously this whole thing up here is about trying to compare all these companies to say, okay, which companies have the best compensation packages? Like that's basically what I'm trying to do up here. But when you're talking about like what metrics do they have to hit in order to get those grants? Well, then it becomes apples and oranges and you can't really compare them super easily. At that point, it just kind of becomes your own subjective view of which one you think is better. Which, I mean, I have my opinions on, but it's hard to weigh that into a final score and ranking system, which by the way is something I have done here. So once we get through all the details, I'll kind of talk about that. But I have turned this into a ranking system. That's what you see here. So these few companies here listed from the left, these are, in my opinion, out of the sample size that I have, which again is very, very small. How many companies are in the sample? 18. Yeah, so there's 18 companies here that I've assessed the compensation packages of. Out of these 18, Fidelity National Financial has the best one, in my opinion. Let's flip back to the earlier part of the conversation when I was talking about the successful long-term compounding that Fidelity National Financial has seen. I mean, I was talking about it just over the 4 to 5 year period that I've held them, but I mean, let's take a look back to 2005, end of 2005 when they first came on the stock exchange, or actually that was when they split off from a previous entity, I'm pretty sure, but because the chairman William Foley has a lot of complicated business dealings, and so really this is a continuation on from a different entity. But the point is, even just looking at that one particular chart, you can see it's like this is some pretty sweet compounding that has been achieved here. And I would kind of point out that that's kind of an interesting factor in and of itself, because as I pointed out, I'm taking a look at specifically the people that are on the executive management and board lists for each of these companies, and then looking at both the CEO and the chairman, and then basically everybody else but the CEO and chairman, and like how do they kind of compare between each other a little bit. Mr. Foley, the chairman of Fidelity National Financial, he doesn't take a salary, which is one thing I thought was really interesting. He's just holding on to his shares, which is one really, really cool concept. Oh wait, no, my bad. That's not even for Fidelity National Financial. I'm mixing two. I'm mixing up FG and Fidelity National Financial because of the fact that they're kind of combined together. He does take a salary for Fidelity National Financial. He doesn't take a salary for FG, and instead just has his huge holdings of FG. Because again, FG is a subsidiary of Fidelity National Financial. In many ways, these two are kind of one company. So it's kind of one thing you have to kind of keep in mind, is that they're kind of tied together. Like FG makes up about a third of FNF's business, and then FG is a subsidiary of FNF. So they're kind of tied at the hip. But I have evaluated them separately here, as you can see. But it's a little bit complicated. Jonathan, off subject, but I found something fascinating recently on a balance sheet. It was for FCC licensing, $2 billion asset with no amortization because it was indefinite. Interesting. What company, if you don't mind my asking? Anyway, equity ownership. Now, another thing that they point out in the proxy statements is the required ownerships for the executive management and the board. Within most companies, they're required to hold a certain amount of shares, and it's usually a multiple of whatever their salaries are. And so that's like a thing I've taken in here, is I have those kind of multiples for those different areas: the CEOs, other officers, chairman, and then other board members. Oh, Siri, of course. Yeah, no shit. I don't know why that wasn't obvious to me. Of course, that should have been obvious. Yeah, I mean, there are plenty of examples of intangible assets that don't amortize. You only amortize when there is a definitive life, and then beyond that, it becomes an impairment. Like that's the option. It's like you either amortize something on a regular basis, or you do a regular form of impairment. And then a lot of the the accounting rules are starting to shift more towards just using the impairment method. So it's possible that even the whole concept of intangible amortization might eventually kind of like go by the wayside, and people might just move on to yearly evaluations of the present value of the intangible and then impair or not based off of that. But that's something that has been, a lot of people in the accounting world have definitely been kind of shifting their feelings about those things. Because like it used to be back in the day when you have an intangible asset, that's what you would do, is you just say, okay, well, it's going to be for this many years, and then you just amortize it, right? Which is fine. Like I'm fine with that method necessarily, but a lot of other people are like, well, we don't really know about that, and it's very indefinite, and all those things are just kind of best guesses. And so why don't you just make your assessment of what the value is as a company? And so yeah, people are starting to shift more towards the impairment approach rather than the amortization approach, and which might be how they're treating that asset. I would have to look closely at the financials to figure that out, but that might be what they're doing there, is that they're holding it until they feel like they need to impair it, which for an FCC licensing, maybe there isn't a whole lot of impairment needed very much, like that might be something that has actually a relatively long shelf life. Hard to say. Anyway, moving on. So the required ownership levels as a multiple of the salary, I then kind of boil that all up and say, okay, well, what percentage is of the total share count are they required to own then, which we have on this line right here, which is kind of neat. So this is something that is affected heavily by the size of the company, is one thing, because of the fact that the salaries don't scale necessarily with market cap, right? And so the ownership levels required based off of these multiples of salaries is therefore going to skew. And so that's why I kind of wanted to point that out, because you can see, like, for example, Apple and Meta are huge mega cap companies, and they're showing up real red on that category because, well, the required ownerships for each of them is like less than a fraction of a percent. It's like 0.001 for Apple, and like, oh, well, that's right. No, for Meta, I'm pretty sure they don't actually have, they didn't even have ownership multiples at all, which is a little bit interesting that Meta didn't have those types of requirements, but they do have huge levels of ownership anyway. Even beyond Zuckerberg himself, they actually do have significant stakes. The rest of the executive management and the insiders. But anyway, so the point is, I wanted to pay attention to that, and also like how much more than was required do they have on hand for any of these given companies. Now, the last of these metrics that I put down here is something that I kind of came up with myself, because this is something I was also thinking about when I was doing a lot of this work. I was like, okay, that's really cool that, some companies have more ownership than others, but as I was just talking about there's this kind of scaling factor where the larger your market cap, the more unreasonable it is to assume that insiders are going to hold a significant portion of the company, right? Like, it's reasonable to assume that for a $1 billion company, that the insiders should have more than 1% of the company, right? Like that's reasonable to assume, because 1% of 1 billion is 10 million. So that means that all of the insiders, which is probably going to be like 15 people or so, right? That's what we have here. It's going to be about 15 people or so. To assume that between 15 people, they hold 10 million in stock, that's not that crazy, right? That's less than $1 million for each one to hold for a $1 billion company to achieve 1% insider ownership, right? So you can see, like, for a $1 billion company, that's no big deal. But what about a $1 trillion company? A $1 trillion company, you now need to have 10 billion in total insider ownership in order to achieve 1% insider ownership. And so that becomes much less reasonable, because that means that now between 15 on average insiders, you would need them to have approaching $1 billion each. And it's just like, is your CFO or your CIO going to be a billionaire? Is that reasonable to assume? It's probably not, right? So it's not fair, in my opinion, to judge a company based off of having a low insider ownership without taking the market cap into account. I think that's something that kind of dawned on me as I was starting to work on this. So I wanted to come up with a slightly different metric to judge how much skin in the game management has, that's separate from just scaling things against the market cap. And the way I came up with this is I went and found some kind of general averages of wealth levels versus income levels from the Federal Reserve economic data website. I went and looked at, I was like, what's the upper quartile of income earners, and then what's the upper 10% of income earners, and then what's the upper quartile of wealth levels versus the upper 10% of wealth levels. And I kind of took like an average between the two, and then I took a ratio between the incomes and the wealth levels. So I was like, okay, based off of these types of income levels that are at like the upper echelon of American society, like the upper brackets of income earners in American society, if they have these types of income levels, they usually have these types of asset levels. And so then based off of the salaries, the salary numbers that I have here, I then was able to kind of come up with like an estimate. It's a super, super broad estimate of what would maybe be a pretty typical wealth level for these insiders. And then based off of that, I then took a ratio to say, okay, well, based off of this estimate of a wealth level, what would be the insider holdings they would have to have for 50% of their wealth to be in this company's stock. And that's what I'm going to call skin in the game, is if an insider, more than 50% of their estimable wealth is in the company stock, then that's what I'm going to consider significant. So that's what I have as these numbers down here. It's actually this number right here. So like for Fidelity National Financial is almost $16 billion market cap. And my estimate is that 0.6% insider ownership would be a reasonable estimate of saying that all of the insiders have approximately 50% of their net worth in that. Now, it's worth noting that for Fidelity National Financial, I actually know already that this number isn't necessarily a great number for them in particular, because as I was mentioning before, the chairman, William Foley, I know that guy is like a mega multi-billionaire. So, and in particular for Fidelity National Financial, he would massively skew this measure. But say for like, I don't know, let's just pick Generac, the next one over here, where my estimate is that for them, who is a $9.6 billion market cap, and based off of the salary ranges that we had there, my estimate is that they would have to have about a 1% insider ownership in order to achieve this estimable 50% skin in the game proxy. And well, they actually have an insider ownership of 2.7%. So that means that they have 1.7% more than is what is required for that. So that's how I'm choosing to judge that. And then like, I think it's a pretty good measure, because like, for example, as I was just talking about for Apple here, if you're just looking at equity ownership, the fact that Apple 0.1% insider ownership, you'd be like, oh my gosh, it's like Apple, they don't have like any insider ownership. And it's like, that's true, but that doesn't mean that they don't have any skin in the game, right? Just because they don't own a significant chunk of the company doesn't mean that they personally don't have skin in the game. It all comes down to what is their wealth level. So my estimate for the skin in the game proxy for Apple is actually less than that. It's actually, what is this here? 0.01%. So as far as I'm concerned, they actually have significant skin in the game relative to their market cap. Now that's another one where I think maybe those numbers are maybe a little bit of an interesting skew, because Tim Cook is also a pretty wealthy guy. But the point is this is kind of the number I came up with. As I said, it's a total estimate. It's going to be on average across all of America, probably about right. But for any individual company, it's going to be skewed on all sorts of different directions. But the point is I needed something that maybe kind of give me a better idea of how much of their personal wealth do they maybe have in here. And I'm pretty happy with that metric as it is. So anyway, the point is I then came up with a scoring system based off of a variety of these metrics relative to the medians here. So that's we're comparing what any individual company has relative to the median level across my sample size. And then I give them a score based off of how many of those factors that they do well in versus how they do poor in. And then we rank them based off of their score. So that's how we end up with the list we have here. From left to right, it is in order of best to worst. So based off of my sample of 18 companies here, Fidelity National Financial has the best compensation and overall ownership for their insiders, followed by Generac, followed by Apple, followed by FG, and so on and so forth down the list. Worst ones on the list: Skyworks, Heidrick and Struggles, and Smith & Wesson, just in case anybody was wondering. But like I said, it's definitely not a random sample size. This sample includes a lot of companies that have decent insider ownership, because that's something I have often used as a criteria when looking for companies. So this is definitely a heavily skewed list. If I was to add like another 100 companies here and kind of like randomly select them from publicly traded companies, we would probably end up with some very different medians. And it wouldn't shock me if like basically all of these 18 companies ended up like in the top half based off of that, right? So just because it's at the bottom of the list doesn't mean it's bad. It just means it's not good compared to the other 15 companies that are in this list as well, right? That's just something you kind of have to keep in mind. But hopefully, like I said, as the list expands, maybe they'll start to be more reasonable and more impressive. Okay, so let's move on to the next topic. Hey, Crit, I don't know if you're still listening or not, but we're finally going to get to it. I know you've been waiting very patiently. So there was a little request from Crit Damage that I would maybe talk a bit about Alimentation Couche-Tard, ATD of Canada, for anybody who's not familiar. This is the owner of Circle K, as well as a variety of other convenience store brands, but in particular, it's well known for its Circle K brand. There has been a lot of news recently about the fact that they have made a friendly, non-binding proposal to 7 & I Holdings of Japan, which is the owner and operator of 7-Eleven. So one very large convenience store chain is looking to potentially acquire another very large convenience store chain and see what comes of that. Now, there isn't a whole lot of super specifics about this deal yet. I don't think they've even named a price. I think they're just kind of in discussions about it. And honestly, I've heard a lot of arguments for why it might not even happen anyway. But the point is that this is definitely a topic people are thinking about. And then ATD themselves is a pretty interesting company. We were talking about qualitative factors and assessing management and compensation packages only earlier so far in the stream. Well, ATD, from my understanding, has some pretty decent ownership as well. Their original founder, I'm pretty sure, is still the chairman of the company. I'm not sure if he's still the CEO, but I'm pretty sure he's still the chairman. And I'm pretty sure he has significant holdings. I believe there's like other members of their family that are maybe still insiders as well. I haven't looked at their proxy statement, so this is literally just me rolling off of what I remember maybe hearing from other people. So like I said, it's like I could be wrong about those details. They're not on that list, right? I was actually kind of hoping to maybe add them to this list before the stream started today, but I just didn't quite get around to doing that. So maybe I'll do that before the next stream 2 weeks from now. But the point is, people are talking about this, and I don't know. You could, first of all, there's assessing ATD on their own as a standalone company, and then there's assessing the deal itself. So I mean, I don't really have too much specific thoughts about the deal itself because, like I said, they haven't given us a price, and obviously any acquisition, it really comes down to what the price was at the end of the day. It's like there's no amazing synergistic acquisition that can't be too expensive, and there's no poor cultural fit acquisition that can't be too cheap, right? It all comes down to price at the end of the day. Like it could be worth making a mess of your company culture if the cheap price was cheap enough, theoretically. That's maybe a bold statement on the negative end of things there. But definitely on the other end of things where you're saying that even if it's a perfect fit and it's like a perfect acquisition, it's perfect strategic choice of an acquisition as well, if the price is too high, well, it doesn't matter, right? So the point is, price is everything when it comes to making any sort of investment decision. So unless we know what the specific deal is, we can't necessarily assess the deal as is. But looking at ATD themselves, I did kind of do some basic valuation work on them, very basic valuation work. I haven't built a model for them, and I want to say that up front because, well, frankly, I do have some questions. I do have some concerns, I think. So just looking at this investor presentation that they came out with, they go through a lot of things here, talking about what they see as their growth opportunity over the next few years. Some of it I agree with, and other parts of it I really don't agree with. So that's the thing where I just wanted to go through some of these details, and then we'll look at the basic valuation as I put together. And like I said, I could be totally wrong. I haven't put together a model for this, so it's possible that if I like really tried to model out how many stores that they would theoretically have, and what types of costs across the different segments, maybe I would come up with some slightly different solutions. But taking a quick look at the history of it, starting in 1980s to 2000, Alain Bouchard, Jacques Demore, I'm probably going to butcher the names, the founders, opened their first convenience store in Quebec, entered the United States in 2001, purchased Circle Corporation from ConocoPhillips in 2003, expanded in Europe in 2012, so on and so forth, all the way up until their recent acquisitions that they've done in the last year or two with Total Energies in Europe and German and Belgium, Luxembourg. I think that's supposed to be Belgium and Luxembourg. So you can see there's their kind of overall footprint, which is one of the first things I kind of wanted to talk about. So in total, they have 16, almost 17,000 total sites across the world. You can see that almost half of them are the United States, which is good. I got no problems with that. That's pretty solid. And Canada, about 2,000. Europe, 5,000 and change, and then other international, which we got some in Africa and the Middle East, some in Southeast Asia, and some in New Zealand as well, of a little over 2 grand. I feel like 2,000 for Canada relative to 7,000 for the United States, that makes me feel like they have too many in Canada. That's one of the first things I want to say here. I could be wrong about that, because like I said, I would have to really look carefully at it, but I'm just thinking about like the relative population sizes. I'm trying to remember, maybe I'm totally remembering wrong. Let me look it up real quick. What is Canada's population? 40 million. Yeah, okay. So no, yeah, I feel like I was right in that assessment then. Okay. 40 million Canadians are served by 2,000 stores, whereas 320 to 330 million Americans are served by 7,000 stores. So I feel like they have too many Canadian stores. I could be wrong about that. Like I said, like it could be a geographic disbursement thing, but it kind of makes me feel like maybe they should not have that many stores in Canada, which gives me some initial worrying concerns. But we'll see about that. I don't know. Like I said, it's like it's hard to know for sure, but that was like one of the first things I kind of noted where I was like, ooh, it makes me feel like they have a bit too much going on in Canada. And then in Europe, you can kind of make a somewhat similar thing. I'm trying to remember also here. I feel like I thought Europe had a similar population as the United States, if I'm remembering correctly. Let me double check. 448 million that live in the European Union. So yeah, more than the United States though. Okay. So maybe that's not as bad then. So Europe is not as bad then. But Canada, I would maybe feel a little concerned about the total count of stores there. Like I feel like they could probably do with half as many Canadian stores. Obviously, it's where they're from, so that's probably part of the reason they have as many stores as they do in Canada, is because like that's where they started, and right up until 2001, that was just where they were. So I can understand like why it is the way it is, but it kind of makes me feel like maybe they should be trying to thin up the store count in Canada. But like I said, I don't know. Maybe I'm totally off on that, because there's other details in this presentation that kind of could theoretically move counter to that idea. So that's not necessarily like a super strong opinion that I have right there. I'm just throwing out my ideas and my thoughts as I kind of went through this. So other stuff here, the geographic mix, just kind of in general, you can see the vast majority of the revenue comes from the United States. A larger share of the gross margins also comes from the United States, which is interesting, which is pretty typical. The United States, very profitable place to do business. And then they have a bunch of pieces in here where they talk about their potential for expansion. So like the 10 for the win plan that they have here, which is kind of like their plan to try to expand their overall EBITDA levels over time. You have this big old plan. Let me get to the right slide for it, where they show how they're moving towards 10 billion in EBITDA, which they say that they can get to by 2028. For reference, they had 1.6 billion EBITDA in 2014, which equated to about 800 million in net earnings attributable to shareholders. You can see it's about half. Their net income is about half of their EBITDA in general over the course of this period of time. So we could assume probably similarly that if they're assuming 10 billion in EBITDA in 2028, then they're theoretically assuming about 5 billion in net income in 2028. which I'll say is like, I feel like that's a bit too bullish, but we'll get into some of the details on that. You can see right here is like, as where they currently are, they had about 5.5 billion in EBITDA, which I estimate is about right based off of the numbers I come up with in my financials. That's give or take about right. Slightly different, things that get included in EBITDA versus don't get included in EBITDA because people do things differently. But point is that's about right. And then net income's about 2.7 billion. It's worth noting that's like there have been years where they've had a little bit of lulls in their growth period, but we actually do have a little bit of a decline here in 2024 versus 2023, which isn't quite what we see here. So it's interesting to see that then they still believe that they can then essentially double their EBITDA over the next 5-year period. See, it's one thing when Lululemon, a company that's a growing brand, says that they're gonna make a big growth over a 5-year period. I think it's a little bit otherwise interesting when a convenience store company thinks that they're going to do that. A pretty well saturated convenience store company. Now, again, there are some pieces in this presentation that do give some good argument for how they can achieve that, and so we're gonna cover some of those details. But I still think it's a bit much, and that's kind of one of my bigger concerns. Okay, so this is where we wanted to be. Here. So this is the first bit that definitely kind of works in their favor. I will say right up front, it does work well in their favor. Here they show the overall market for convenience stores. Or actually, the thing is like they're not even super specific here. So I'm not even 100% sure if they're talking about convenience stores here or if they're using a much broader category because they're not really giving a super specific piece of information. They're just saying that this is the industry stuff. So that it's actually kind of hard to read between the lines. Maybe this means convenience stores, but maybe this means convenience stores and this and that, right? Like when companies like to define their TAM, they're usually as generous as they can be to whatever their market opportunity is. They're generally not going to narrow themselves in terms of what their opportunities are, because when they're talking to investors, they're trying to sell the stock, right? So one of the things you kind of have to always be skeptical when you're reading these investor presentations, because you have to remember that the goal is to sell to you. The goal is to get you and go out and buy their shares, which, maybe is the right decision. But the point is at the end of the day, you have to kind of keep that in mind, that the guy that put this presentation together is literally trying to get you to buy something. So it's one of those things where you have to be careful about what you take for granted when you read these things. But this could be convenience stores. This could be some broader selection of store categories. I'm not sure. I would have to look into that. But the point is, either way, they point out that it's a highly fragmented industry. They're showing here that there's 145,000 total stores in the United States. This is just the United States we're talking about in 2006 versus 152,000 in 2023. So they're showing that the overall store count has moved up over time. It's slow growth over time, but we're talking about a well-saturated market. So any growth is fine. It's down from peak levels, it appears, though, in 2026 and 2017. So that's one other thing that I would say is maybe a concern, is that we've seen a little bit of kind of a cyclical lull in the growth of these categories of stores. They're talking about the consolidation opportunities, which the opportunity still exists, but it could be that we are at the point where that consolidation is really going to start to be the only source of growth for that industry, because it could be that many of these are going to start to go bankrupt, and that we're just going to have a lot of consolidation into larger players like Circle K and like 7-Eleven. Then they segmented it all into single stores versus chain stores. So single store convenience stores, like one single little quickie mart type thing that isn't attached to some larger brand, versus larger chain groupings. And again, it's hard to know what kind of categorization they're talking about here. They even segmented off into how many of a chain too. So 2 to 10 stores, 11 to 100 stores, 101 to 500 versus 500 plus. So the point is that they're trying to show that there's this huge opportunity for consolidation within their industry, which appears to be true one way or the other, no matter how they spell it here. Even if this was a larger segmentation of stores, this still looks like a lot of consolidation opportunity. Then the question is can they be the one to achieve it? And two, what is it going to cost them to achieve it? Now, that first part I'm less concerned about, because they have shown themselves to be remarkably good at consolidation. I can't remember which slide it's at in here, because they have like so many slides. Here, they have actually made lots of deals going back to 2004. They show how they've successfully done 75 deals since 2004, adding 13,000 stores in total. So they've already shown the ability, the willingness and the capabilities to actually do lots of acquisitions in the past, which does make it seem like, okay, they probably could continue them. Why not? Why wouldn't they be able to do that? And then again, obviously, at the beginning of this conversation, we were talking about 7-Eleven. So if they were to consolidate 7-Eleven, they would become by far the largest player within that space too. So maybe they could. Maybe they could continue to acquire all those companies. I don't see why they wouldn't be able to integrate them. It seems like they've had a relative success in doing so. My concern at that point would then be at what costs would they be getting it? Because acquisitions aren't free. I don't know. It seems to me like sometimes people forget that acquisitions aren't free. Sometimes people pretend like it's always just an obvious win-win to do an acquisition. And I think this is also even doubly so when it comes to small acquisitions. I feel like people do automatically become more skeptical when it's a large acquisition, but when it's a tiny little bolt-on acquisition, people tend to kind of automatically assume that that's automatically accretive to value. When at the end of the day, the company selling the company wants their value too. So unless there is a disconnect between how the values are being assessed, which is often the case between private and public markets, and that's one of the reasons that by acquiring a private entity and adding it to your already existing public company, you can often actually get some real creative value from acquisitions. But the point is you just don't automatically assume it. That's all I'm saying. Then they show like the level of total sales that have actually occurred within the industry here, showing that like the sales have actually been accelerating over time. So people are really starting to consolidate within this industry, which would maybe explain why the total store count has actually started to come down a little bit, because, well, frankly, if these bars are going to go up faster and faster, that means the ability for these total bars to move up becomes basically less possible over time. So like I said, I buy into the acquisition story. I do buy into the acquisition story. I see why they could totally continue to be successful in that regard. I'm just not so convinced that it's necessarily going to be some huge margin expanding opportunity for them necessarily based off of that. Now, the things that I'm less buy into, they talk about throughout this presentation. It's like many slides here, so I'm going to kind of flip past it. But they talk about how they're going to improve their EBITDA in small little chunks that they kind of talk about per slide here, based off of different categories and different things. So like winning in food, I'm not necessarily convinced that Circle K is going to become ever more super valuable because of their ability to sell more food or maybe more drinks. I believe the ability to sell more drinks more than the ability to sell more food. But then there's going to also be other things too. They're talking about being able to sell other like consumer goods, private brands, little small electronics and things like that. I'm not necessarily convinced that that's going to really be some super creative add to them. Like, yeah, they could probably sell more of those things, but is that going to add more value to the company is what I'm going to say. It's like, are people really going to want to buy things from Circle K more than Amazon? That seems kind of like a weird thing to assume. So it's like I said, I'm willing to buy onto like how the acquisitions are going to be a huge driver for growth for them, but not necessarily a lot of these other little subcategories they go into. Crit, sorry, but I was on pause, so lagging around 20 minutes. So Lumen Group has the bonus plan, which you talked about, and I believe Topicus as well, because they are both CSU spinouts. Okay, cool, thanks. I'll totally go look into some of those a little bit. And yeah, you being behind that definitely explains why you didn't start talking as soon as I started talking about ATD, but you'll catch up shortly, I'm sure. But cool, thanks. I'll look into those too. Anyway, continuing downward, private brand. There's some other little side categorizations they talk about. Delivering on customer promise. So like adding, doing rewards programs, extra programs for their customers, fuel days, savings points, and things like that. A little bit kind of like reward systems within that. I'm also not necessarily convinced how that's going to necessarily be accretive to them. It's like, it seems to me like those are things that are going to help them defend their brand, but I'm not necessarily convinced it's going to add some massive amount to their value. That's the thing, is like they talk about a lot of things here. I don't really want to go through every single category of it, but the point is, let's go back down to the where's that? I want to talk about this one though. Oh, whatever. Well, let's move on, because we're already getting close to 2 hours, so I do kind of want to get to the actual value about this so that we can maybe close up a little bit. Back down to the chart with the 10 billion. We'll talk about this one a little bit because this one's kind of important. Obviously, the fact that they are a convenience store that is often attached to gas stations, we would be remiss if we didn't talk about the fact that there is obviously an evolution going on within that. Which this is one thing I was actually pleased to see. One thing is that they have already done a good job of beginning that evolution within Europe, which makes sense, especially within Europe. And I definitely kind of wonder if this is part of the reason that Crit is maybe so bullish on them, because I know his geographic area maybe gives him a little bit more of a focus on this, so maybe he's seeing some of the results of these things a little bit better, and that maybe gives him more confidence in some of the ability for them to evolve with the changing of the e-mobility impact, as they're talking about here, relative to other people. But the point is they've done a good job of adding chargers to a lot of their areas throughout Europe, and they're expanding throughout Europe, which Europe, especially Northern Europe, is a lot of the areas where there is higher levels of EV penetration as of yet. So that's very good that they've actually done a good job of doing that. They have, it shows their market share numbers here. I can't necessarily say how super accurate that is, but we can assume that that's maybe about accurate. But 9% of the charger market share in Norway, 9% Sweden, 13% Denmark, 1% Germany, 3% Netherlands, 4% Belgium. That's pretty decent. Again, we're talking about a highly fragmented industry, right? So it's like, think about like what market share of total gas stations maybe they would have. And like that's kind of the idea, right? Then there's obviously the argument about self-driving versus non-self-driving. I'm not a huge believer that like self-driving is going to be some super overvamped thing very, very quickly. But the point is if people do use less cars, then that comes back around to the questions I had at the start about the total store counts. I was focusing more on Canada, but the point is if there is going to be a large evolution in the forms of travel that people are using, not only to just to electric, but specifically to self-driving, if that becomes a larger thing over time, well, then there's going to be a lot less people that actually need vehicles in general if the ride hailing thing becomes like a major factor. So theoretically, maybe they would need less locations on that too. So I would say is like, well, I was saying like I can buy into the acquisition story. It's also viable that the industry and the technology could change in such a way that that's no longer a desirable outcome. So I don't know, it's hard to say. But then coming back around to your like their overall path for the EBITDA, they're talking about 1.1 billion of it coming from M&A. They say that right here, and then 8.9 billion coming from organic growth, including Total Energies. I didn't specifically quantify the ones that I buy versus not buy, but I would say like I can maybe only assume that the growth, like half of this other category of growth, like I can maybe buy the M&A portion, but then they have 8.9 here from that. Let's see, like 8.9 minus 5.6, that's going to be 3.3. 3.3 in difference, and then I would say maybe half of that'd be 1.6. So 1.6 plus 5.6 is going to get you 7.2, and then maybe throw that 1.1 back on there. That would maybe get you to 8.3. So if I was to be skeptical of a lot of those other categories that they were saying that they were going to get growth in EBITDA and synergies from, and if I was more skeptical about those categories, but then pretty generous about the M&A category, then I would argue that maybe by 2028, based off of that, I could see like an 8.3 billion in EBITDA number. Again, total spitball, napkin math kind of calculation there. I haven't built any sort of model for the company. This is just kind of me like saying like based off of some of the things they talk about in here, how much do I at first glance think it's a reasonable guess versus somebody just trying to sell a great story to me. I could maybe buy them getting to like 8.3 billion or something like that. And then keep in mind, as I said before, their net incomes here appear to be approximately half of the EBITDA number, give or take, maybe slightly higher than that, but 8.3, half of that would be 4.15, so 4.2 maybe to make it slightly higher than that, 4.2, maybe 4.3. You could see for that, for net incomes, which we could say is approximately cash flows, give or take over a longer period of time, right? So let's go take a look at some stuff. We already kind of looked at the financials a little bit, but we probably want to look at them a little bit more for at least a brief period. Operating margins, not great operating margins. 5.25% on average over the last 10 years, including the last trailing 12-month period. If I look at the first 6 and then the last 6, because we have kind of 11 if you count the trailing 12-month period here. Then that means that like in the first half of the decade, they were at more like 4.5%. And then the last half of the decade, they pushed up more towards 6%. This last half is inclusive of 2020 and onward. So that makes me skeptical. The big jump, not a big jump, but a jump for a company that has low operating margins to still low operating margins, but slightly higher, right? It's like, it makes me feel like maybe the 4.5 is more realistic than the 5.5 or the 6. But the average over the whole period is 5.25. So even if we just assume 5% as a reasonable assumption for margins, maybe, the kind of like a returning, a reversion to mean for the operating margins there. And then looking at cash flows, it all comes down to, like I said, they do a lot of acquisitions. So if we're just looking at the adjusted cash flow margins over the last 10 years, on average, it's only been like 1.5%. But again, that's because they have a lot of acquisitions in there. Acquisitions, which as a percentage of sales have been like 2.7% at a given period of time. So if we were to back all the acquisitions out, we actually end up with a cash flow margin of more like 4.5% over the 10-year period. And then if we were also to say what was net reinvestment, not counting acquisitions, then it goes from 2.7% actually to about flat, maybe even slightly negative. So, which means that they have slightly more depreciation and amortization than they have capital expenditures and changes in net working capital. So that's what I would say here is that low operating margins, but perhaps not really any real reinvestment needs. Not counting acquisitions. Like acquisitions are basically their only real net reinvestment needs for the most part, which kind of makes sense. It's like low margin businesses tend to be more capital efficient on that way. It's like there's usually a give and take. It's like if you have high margins, you usually had to pay high capital costs up front in order to get those margins. And so you usually have high capital costs and high margins, or low capital costs and low margins. There are exceptions to that, but in general, that is kind of the way most industries work, is that you don't get something for free. At the end of the day, it's the cash flow margin, which is kind of the combination between those two things that gets you to that point. Your comments again. Can you look at CRM where SBC is going down and free cash flow is going up? I'm still lagging, so don't know if you're still live. I am still live, but I definitely have moved on from that topic. I will look at CRM after the show and maybe comment in the Discord if I find anything about that. I'll try to remember and get around to that at some point tonight, maybe. SBC is going down and free cash flow is going up. Well, I mean, is that the normal free cash flow number that doesn't account for SBC in the first place, and then, or is that like an adjusted free cash flow? Because like here, when I say adjusted free cash flow, that's because I've taken SBC out. But anyway, I'll look into it. Anyway, moving on. Let's take a look at the actual valuation I made for the company. First and foremost, we'll come over to ticker estimates. GE. So they're expected to have a 10% to 11% revenue growth this year. Relatively strong amounts of analysts are pulling for these numbers. And then it's expected to come back down to a more moderate level of growth for the year after that in 2026. And then they're expecting a decline here in 2027, which is interesting, but it is also only 4 analysts that made that number versus the like 13, 14. So it's worth noting that that could just be an early estimate that's like way off or something. But very interesting to see there's a weird decline there. I'm not necessarily sure. I think that this big bump in the 10 to 11% is basically them integrating Total Energies from Europe into their system. That's kind of like what's expected here. And then there's also relatively stable margins for here for the most part, 5.5% as we've been seeing. And then there's an expectation of 6.6% in that last year here. Though again, we have the same sort of effect where there's larger amounts of analysts on the first two and then not as much on that last one. So it's possible that'll change over time. And it's also further out in the future. So people can get away with being more optimistic when they're an analyst and it's not next year's number, because people aren't going to judge them off of the 2 years and 3 year forward numbers. They're going to judge them off of the number they said is happening next year or the next upcoming year, right? So by the time they get around to those second, third years, they can adjust them before people start to judge them for it. It's just the thing when it comes to analyst estimates is they kind of have to realize that the most recent next upcoming year is really the one that analysts get hired and fired on, right? Like that's the real bank breaker for the analysts. Anyway, so then moving on past that line there, we also have cash flows. They've had kind of in the like 2 billions kind of range of cash flows for the last few years. They had like less than $1 billion prior to that, so they've been revving up towards in those cash flows, partially as off of the backs of some significant acquisitions, as we were kind of talking about. We had like 4.3 billion with the total energies in 2023 through 2024, almost $1 billion in the 22 to 23, and then smaller amount in 22, and then $500 million in 21. So they're doing some solid acquiring here, not necessarily some bigger ones, but on average in general, they're always doing acquiring. So that's just kind of the thing you have to pay attention to. So anyway, coming back over to the cash flows, expecting in general for the next 3 years about 3 billion in cash flow. That's the estimates we have. Again, limited numbers of estimates, but in general, about 3 billion is what the estimates are. Again, remember that their expectation is that by 2028 they're going to get to EBITDA of 10 billion. Here's the EBITDA estimate. EBITDA of 6 billion, 6.6, 7.2. They're saying that the next estimate that the analyst put out is going to be a 10. That's what they're assuming here, or at least that's what ATD assumes. Again, it seems like even the analysts don't really buy that story. Again, I don't think these numbers include 7-Eleven. That's one other thing to keep there. It's like they could very easily get there by acquiring 7-Eleven, obviously. But then at that point, like I said before, it all comes down to price, because who cares if you have $10 billion in EBITDA if you have to take on a $30 billion debt load in order to do it? And that's exactly what it would be, because 7-Eleven is a $30 billion company. That's why I'm saying that. So, oh, 40 billion, my bad. It was 30 billion before they had the pop on the announcement. So actually it's a $40 billion company. So like, at what price are they going to get them? Are they going to pay cash? Or are they going to pay shares? They don't have a crazy debt level ATD themselves. So like if they did pay in cash and took on the debt levels, they could probably do it. Like they could pull it off. It wouldn't bankrupt them, but it would be a huge drag on their cash flows coming from the interest levels and then the eventual principal payments themselves. And then of course they could also issue shares to do it. So that's the other thing too, where it's like, well, then that would be a huge dilution factor, and that would mean that the EPS you get off of that EBITDA would be significantly lower. So I would say it's like, they could definitely get to the targets they're arguing for in their investor presentation, but it's not necessarily going to be as obvious and easy as how that's going to be accretive to shareholder value in the long run. And it might be in the long run, but the point is time is a factor too. So they're talking by 2028, they're going to have strong accretive EBITDA, blah, 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 blah. Maybe it's going to take much longer for that to really get solidly integrated. It's hard to tell. Dan the man, Dan the gentleman, good to see you. Where's my mustache? Yeah, look, I'm not really a mustache guy. I thought about doing it because, like, look, I just trim my face. I don't even shave. I'm not really a big shaver. I just use trimmer, and I do it like once a week. I keep it real simple. How I like to keep myself clean. Which, I mean, I can grow a tiny level of mustache over the course of the week, but the point is like I would have had to do that over the course of like several weeks in order to like actually get a substantial mustache to fulfill Crit's wishes there. But I didn't want to, I didn't really want to do that, because then people would be like asking me in my private life, like, why do you have a mustache? Are you growing a mustache now? And it's like, oh no, I'm just growing it out for like 5 to 6 weeks because some guy on YouTube and on my Discord wants me to. So yeah, I decided not to do the mustache. It's not really my bag, baby. It's just not my thing. Anyway, back to the ATD valuation. Good to see you though. Anyway, so coming over here, I put some numbers in. We're kind of running off of the expected revenues in the short run for ATD. Did it switch some stuff around? Okay, so up to 76, 78, 77. I kind of decided to just like let it roll with that, but I didn't really want to do like this like up, down in the revenues kind of game. So I chose to just like allow them to get up to those revenues and then kind of build from there. Honestly, I think in the revenue category, I chose to be basically very generous to them. I basically chose to say that they succeed in strong integration with Total Energies. They succeed in doing lots of acquisitions at relatively cheap costs. It's not really including 7-Eleven because that would have required many more larger adjustments. But the point is, we're assuming that basically they have lots of major acquisitions in these first few years, enough to get them to a significant jump in revenue of about 30% by 2028. To really get them up there, a total of like 44% by the full 10 years or so, which gets them a compounded growth rate of only 3.7%. But the point is, we're front loading that growth. We're like really front loading the growth for them, which you can see here. It's like we have our bear case where really they grow a little bit in these first couple years, but then they just grow at like less than inflation after that, right? Almost zero for those next 5 years like that. And then more moderate kind of inflation-like growth in this particular case. And then this is like the strong acquisition case, right? So that's the way I chose to play out with the revenues. Like I said, I didn't build a model for this one, so it's possible that if I like really got into the nitty-gritty, I would come up with totally different conclusions, but I just kept it more simple in that front. Dan's asking, the live today, has it had a theme or is it more free? I mean, a little bit of both. I've tried to cover a lot of stuff, but we have kind of kept with some major themes. A lot of the earlier part of the live stream, I was talking about like all the changes in my portfolio over the last 4 or 5 months, my changes around thinking about quality, and like I kind of got into some of the details about how I'm doing that. I built like a qualitative star rating system for all of my companies, which I'm still working on, kind of trying to implement. I changed my allocation system. I got rid of several holdings and have been concentrating more into some of my more core holdings, so a lesser pool of companies. And then I went pretty deep on stock compensation packages and like executive and director insider ownership and compensation. I built like a pretty fancy spreadsheet for looking at and assessing the skin in the game of management teams and insiders. So I would definitely recommend maybe after we're done live, maybe going back and watching that section in particular, because that stuff's pretty cool. But we'll probably be seeing that a lot in the lives going forward. So it's not like won't see it again for sure. But I get into a lot of the details of it, at least there. And then I was looking for some examples, and then we talked a little bit in depth about Lululemon, which is one company I've been buying recently. We definitely had some discussion in the chat about disagreements about the potentials that they have for that. Because like I'm arguing that I think they have some decent growth opportunities in front of them still, and the valuation is definitely somewhat dependent on continuing growth for them. So some people are looking at like a multiple of I think it's trading at like 18.5 forward PE right now, and people were saying, oh, that doesn't sound very cheap. And it's like, well, yeah, but growth is where the question comes in. And then I also think that Lulu is a decently qualitative company, not like the highest of quality brands, but I do think that within the space they operate, they're doing relatively well in that regard. So I kind of gave my simple bullish thesis for Lululemon. And then now we've been talking about Alimentation Couche-Tard, ATD, from Canada, the owner of Circle K, which was a request of Crits. So we've been kind of like going deep on that. I did do some basic valuation work for him on that that we've been now covering, and that's probably how we're going to close out today. I'm going to finish up this valuation, and that'll basically be it for the show. So yeah, we'll finish up that. So anyway, as I just said, I gave you guys kind of the growth estimates. Then for margins, as I had kind of showed you with the financials, 5.25% on average for the last 10 years, more like 6% for the last 5 years, and then more like 4.5% for the 5 years prior to that. So I kind of kept with that. For the next 5 years, we're going to assume that it's about 5%, 5.2% on average, moving from the kind of the 6% downward. I'm really not buying that they're going to have sustainable higher margins that long, and then I'm also assuming that it's going to come down a little bit over time in the terminal case too. So I'm really kind of a slow meandering from 5.8% down to 4.9% over a 10-year period. It's like very slight drop in margins, back basically close to their longer term average, actually slightly lower than the last 10-year average, but that's because it's in the terminal year. So you could argue maybe I'm being conservative there. But like I said, I do think I was being generous to them in the revenue cases, partially because like it's hard to know just how much they can pull off the kind of consolidation within their fragmented industry. And then when it comes to capital expenditures, I was already talking about how in general, if you're not counting acquisitions, major acquisitions, their reinvestment levels tend to be relatively flat. It tends to be basically about a net reinvestment of about approximately zero. So over the next 10 years, we kind of allow for basically about that to play out. We have some levels of reinvestment here up front, which is to pay for some of those acquisitions of the high levels of growth up front. And then in the back half, we move towards a net de-investment of about 1%, a little bit more than 1%. So we're basically going to assume that in the terminal year, they're going to start having much less capital expenditures and much more depreciation and amortization, or even divestitures as well. So those would add cash flows to them at that point in time. And so the cash flow levels that we end up with, therefore, for the first 5 years is about 3.3 billion on average. And this is in USD for the record. I know their share price is shown in Canadian, but we're all the financials are in USD, and then we also have the price converted to USD figure already within the valuation, so that'll be kind of accounted for. But so keep that in mind that like it's Canadian $75, but in USD that's $50. It's about 2 for 3 ratio between the two. I can flip here to show you. See, $55. So yeah, 75, 55. That's the conversion ratio right now. So yeah, 3.3 billion or so for the first 5 years in free cash flows, and then the second 5 years I get to more like 4.1 billion. Now remember what we were talking about with the estimates they had here. I was saying that I didn't really buy the 10 billion EBITDA target. I found that it might be more reasonable to assume something like an 8.3 billion if I was to kind of count half of these organic opportunities they counted about, and then generously allow them to have their 1.1 billion from M&A. And that gets me to more like an 8.3 billion. And that's in 2028, which I still found was a little bit fast. So like I didn't really allow them to get necessarily there. And then I said that it would be approximately half of the EBITDA number is what their net income is, which it shows kind of like right here. And then we can kind of assume the net incomes and free cash flows in the long run are good proxies for each other. That's only really true if the company has no debt, technically speaking, but whatever, we're kind of making some basic assumptions here. But the point is like 8.3 billion would get you 4.2 billion in cash flows. I got 4.1 here. So yeah, you can see like we're getting approximately in the range of the stuff we were talking about, give or take. It's still a little bit of an estimate. And again, I didn't model any of this out, so this is all some relatively spitball estimates. Dan, Midas, do you still hold ATKR? If yes, can you just go over what is the case behind the investment if you still have time, but the explanation doesn't need to be detailed, just basic? Unfortunately, I never had ATKR. I've talked about ATKR. I made a video on them and I've talked about them a few times. And I know Well Invested in the Discord has them. So you might be confusing me with him, unless you really did think we both had it, which is possible too. And then Jeff also has ATKR. In fact, he's probably like the original ATKR bull from the channel for the most part. So I've never actually had them. I'm interested in them. I do think they're an interesting company, and I've kind of been keeping my eye on them a lot. It's worth noting that like they're actually back down to the prices that I said that they were worth when I made my video originally. Like I made my video originally kind of like around here or so, and I said they were overvalued here. And then they went on to do this, and you know I looked like a big idiot. And then they went ahead and did this. So, you know, one of those things where I've been feeling pretty vindicated lately. But I do think potentially there is a good opportunity with an ATKR. I just haven't done a super close analysis of them recently. What with, like I said, all of the kind of like qualitative things that I'm really trying to be a lot more careful with. So I am interested in them, but I want to take a lot closer of a look at their industry to really kind of get an assessment of how I feel about their place within their industry. And then I want to take an even closer look at their management team and try to assess how I feel about the management team, and then maybe build a new model for them. Because I know the model I built for them originally was like very crude. I wasn't able to find the kind of information I usually like to use in my models. It was definitely not the kind of style of model I like to make as much. And so I definitely would really, really like to redo my model for them. But I do have like some basic valuations on deck like I already have that I'm keeping track of for ATKR. So it does appear at first glance that ATKR is undervalued. It does appear so. I just am not so confident that it is to start a position yet. But I am interested in the company, definitely. It's hard not to look at that drop and think, is there something there, right? So yeah. If you want some details on the bullish thesis, I would actually specifically ask Jeff and Well Invested in the Discord. I mean, obviously I could say some stuff too, but like I said, they're the bulls. They're the bulls right now within our little community on ATKR. So I would ask them in particular. So anyway, getting over to the actual final value with all the estimates put together, they do actually have a relatively low cost of capital up front here in the short term, which is pretty sweet. Comes, I think, from, in general, just the very stable level of the type of business they operate in. They do actually mention that at one point in one of the slides here about like how, in general, counter-cyclical they actually can be, recession resilient, right? Like this is convenience stores. Circle K is a very recession resilient type business model. It's like the profitability of gasoline probably changes during recession significantly, but that's not actually something that necessarily hits it doesn't create a volatility for them necessarily because they're not really the producers, they're just the end sellers. And so because of the way that the margins work within that doesn't necessarily have the biggest impact on them as it might have for like an oil major, for example. And then there's the other part of the business that's not related to gasoline, which is going to be a much more stronger buoy against that during recessionary period of time. I can't remember what slide it is. I don't know why I'm flipping through it. But the point is, there's a good argument there. They have very low beta. Even if you adjust for debt, once you take it out to get to their asset beta level, the overall beta of this industry is pretty low, which gets us to a low cost of capital in the short run, which is good. It's a good buoy to their value in general. However, it's also a relatively mature industry that doesn't have a whole ton of growth opportunities that exist as an industry. It's only within the industry, the consolidation opportunities that really exist that creates growth opportunities. And therefore, the terminal multiple that we apply to this type of company is not going to be that high. I do give a little bit of a boost to the terminal multiple, a little bit. Like I was told, based off of my kind of system of trying to come up with it, I end up with more like a 14 to 15 terminal multiple. And I did give them a little bit of a boost to more like 15 and a half, 15.6, based off of the quality of their management. Like I said, I haven't done like a full review of the management quality in ATD, but from what I understand of the founders and their insider holdings, I was willing to give them at least a little bit of a boost up front so that this valuation would maybe reflect something close to what my end result might look like for crit. So the point is that this is what I end up with. I end up with fair value of 47.80 USD, and that's USD, 47 to 48 bucks against the USD price of $55 per share. So overvalued by about 13% is what I see here. 73rd percentile is what I end up with. Again, it's like it's getting a bit cheaper. That's also part of the reason we're talking about it. I think like this is part of the reason we're having a discussion is that it has had a little bit of a nice pullback here, but it's not an extreme pullback, right? Like this isn't, we're on the weekly. Let's pull in closer on the dailies. It's not some super extreme pullback. It's just a decent pullback. But look at how smooth and steady that is. You see the low beta in effect right here. This is nice. It's definitely a nice company to own. Like this would be a great company to own because it does have those good kind of compounding qualitative factors to it to a certain extent. Like you can kind of already tell it to a certain extent, but I don't necessarily think it's super cheap. What I would say, right, whenever you do catch up to this point, I know you're still probably like 15 to 20 minutes behind in the stream, but whenever you do catch up this point, like I said, it's like, I know, you're probably not going to be happy with this because you wish that it's a great value or something, and so you'll probably think that I'm wrong. But what I would say is that, acquisitions often come with a lot of headaches too. So maybe they do pull off the 7-Eleven acquisition and then maybe 6 months later, integration's not going so well initially, and then maybe by that point it's not at $73. Maybe it's down to like 65, $60 Canadian USD, and then at that point it would be below my USD target as well. So the point is it wouldn't shock me if it got cheaper. It wouldn't shock me if, because they're trying to do this big acquisition, maybe an even better opportunity presents itself at some point in the near future. Hard to say. But yeah, I'm not gonna buy them today. But I don't know. Maybe at some point I will build a full model for them, because I mean this isn't too crazy far off, right? So like I said, it's like maybe I've got some stuff wrong here, and maybe it does look better in the end, because I mean it's within the quartile, right? So it's like it's in a range that if I'm off by just like a reasonable level of assumptions, if you just were bullish enough to believe the 75th percentile, then it's at fair value right now, with a tiny amount of margin, right? So because like that's the way I look at these quartile ranges. I look at it as the first quartile and the third quartile are equally as reasonable of a number to assume. And to be honest, they're also equally as reasonable as the median. Like it's really this whole range that's pretty reasonable to guess. It all comes down to how bullish you feel about the assumptions that I put in here. Because again, that's why we make our bull, bear, and base case for growth, margins, capital, and discount rates. Because then taking all those factors into account, you can say, well, what if you're just wrong about one of those factors? You know, just one of those factors to a significant degree could easily get you to a fair value of $57 USD, which would, you know, get them around around the $75 Canadian. So I don't think it's a fair value right now, based off these estimates, but I could easily be wrong by a wide enough margin to make it fair value. But I could also be wrong by a wide enough margin to make it even worse too. That's kind of the point, is that in my opinion, $57 fair value is equally as likely as $38, $39. Again, USD, we're talking USD. I know when we switch between currencies, it can get a little confusing. So yeah, that's Alimentation Couche-Tard. I do think it's a very nifty business. Like it's definitely like, I think the type of franchise you would like to own, but you want to own it at the right price, as with everything in investing. So that's pretty much that. Okay, so that's it, guys. I was hoping to do 2 hours today. That was kind of the goal. So we did manage to hit 2 hours. Initially, I was like, oh man, because like, you know, back in the past when I did live streams, oftentimes I would just be tired by an hour and a half, and my voice starts to go. Like I can definitely feel my throat's a little dry, and you know, I always have my coffee here. I have more coffee I could go get, but I'm just too busy talking. I'm too busy yapping that I never quite want to stop to like go think about that. My brain just kind of like moves on to the next subject like immediately, or somebody asks a question that carries me to the next subject. You know, that's always the thing. So anyway, I appreciate everybody coming out though. It's pretty cool that we at least had a nice little crowd here of like, you know, half a dozen of you guys at any given point. I see you guys were liking the stream as well. Anybody who watches on the replay, please like the stream. Please subscribe to the channel if you haven't already. It'd be really, really appreciated. That way you get notified whenever I go live. As I've said a couple times in the show, I'm hoping to do live streams now every 2 weeks at least. That's the goal. So hopefully I'll see you guys in 2 weeks. I'm not sure when I'll be putting out new like full edited videos, because I am still trying to kind of like really really kind of think carefully about how I want to make my cases on YouTube going forward. I'm trying to be much more thorough, much more comprehensive, especially on the qualitative aspects of things. So I'm not going to make a new like normal valuation video until I feel like I have a really, really strong qualitative assessment of the company that I can give you guys as well. But the point is yeah, hopefully at some point we'll get those rolling as well. But live streams, I'm definitely hoping to do at least regularly going forward. So again, I appreciate you guys coming out with me. Join the Discord if you haven't already. It's free. The pinned comment in the chat is the link is also in the description below. As I also said at the start of the stream, if you do join the Discord, we do have a bot and spam filtering system, so you do have to manually be allowed in. So if you do join the Discord, you will not be able to see anything for like the first few hours to a day or so until a mod lets you in. You can message mods to ask them to let you in and stuff like that. But the point is be patient. Somebody will let you in eventually. All right. Catch you all in the next live stream.